And now we'll discuss nature, scope, and objective of an audit. First, we'll see what is an audit. An audit is an independent examination of financial information. It is a financial information, okay. And the examination is of what? Independent. Okay. Whether that entity, what are the qualifications for the entity? It could be a profit oriented or not profit oriented, irrespective of its size or legal from any size, whether it's any form. When an examination is conducted with a view for expressing an opinion thereon, they are talking about the output. What we have to do with regards to the audit, we have to form an opinion over that. So when we form an opinion, which examination through an examination which is independent of an entity, whether it's profit oriented or not, depends upon, irrespective of the size and legal form. And with that said, that's the definition of audit. Now we'll see what are the scope of audit. Yeah, as we said, the audit is audit of what? Examination of financial information in our definition, right? Now even the scope of the audit contains all the financial data also. You see, it covers adequately all the relevant enterprises, and that is entities relevant financial statement. That's what financial information is. And account records and other source data is reliable or sufficient. Whether the other information apart from the financial statement, the other information in the accounting records and those source data is reliable and sufficient. As of to data, what all the adjectives that we thought, it has to be sufficient and appropriate with regards to audit evidence, any kind of audit evidence. Apart from that, whenever data comes with not in respect to the audit evidence and all, it has to be sufficient, relevance, reliable, and all that. All these words have to be come. You have to dump those words. Those what we call as keywords. Okay, and all the relevant information was properly disclosed. So you see, while just applying any kind of standards, what we do, we first identify and then we just present that and just disclose all that, right? All the presentation, disclosure, and all has to be done. For everything, the information has to be disclosed now. All the whether the disclosures were properly disclosed or not, all the relevant information and all with regards to disclosures. First thing, financial information, and we have to check the source data was reliable or sufficient, the other information and other relevant information was properly disclosed or not. And auditor assess the reliability and sufficiency. Here what the auditor wanted to do, he wanted to know the reliability and sufficiency of the other information, right? How could he do? We have what, like 6 to 7 items, like how do we obtain sufficient appropriate audit evidence, right? Like inspection, inquiry, and reperformance, recalculation, observation, like that, right? And the same thing you could write that also, but with regards to only this standard, particularly making a study and evaluation of accounting systems and internal controls. When you have went for audit of financial statements, what do, under which department the financial statements were prepared? Under audit department. So what we have to observe, you have to make a study and evaluate. You have to evaluate what? Accounting systems and internal controls. Why internal controls? Audit is only for the financial statements, right? Why we have to also check the internal controls? We also have to check internal controls because we have to also check the environment in which the financial statements were prepared. Environment with the internal controls, which would also influence the financial statements, data entry, and all, whether the controls were efficient for making the financial statements reliable or not. And we have to check the accounting systems in preparation and their internal controls and carry out such other test inquiries and other information procedures of accounting transaction, accounting balance he considers appropriate. All the things with regards to transactions and balances, transactions in P&L account, balances with respect to the balance sheet. Okay, and the auditor determines whether the relevant information is properly disclosed. Again, the disclosed has come as he has to check, right, whether they have been disclosed or not. How he would do? By comparing the financial statements with the accounting records and the source data, whether they properly summarize the transaction and events recorded therein, and considering the judgments that the management had made, judgments with regards to any kind of, like with regards to the provision for bad debts and all, there were a few judgments that the management has to make, right? Those judgments with regards to any kind of compensation that have to be paid, with regards to any kind of litigations and claims, right? And all those judgments whether management had made appropriately or not. You see, financial statement contains all these judgments, estimates, and all the accounting policies and accounting transactions, balances, future events, subsequent events. All these have to be taken into consideration. You have to write with regards to all of that, with including the keywords like what? Reliable, sufficient, and with regards to any kind of operating effectively, the internal controls, etc. You have to use these keywords and all the matters with regards to that, which would form a scope of audit. And audit, what all you find in a financial statement, you have to write like accounting records, financial statement, accounting balance, and all these consist of scope of audit. And auditor is not expected to perform duties that fall outside the scope of his competence. Audit is not an investigation. Audit has a limited scope, so auditor has to perform his duties in that scope only. And what are the aspects that were covered in audit? You see, examination of accounting and internal control system, which we have discussed in the scope. Why? Because financial statement were prepared under the accounting department or accounting systems and the internal controls with regards to that. And review the systems and procedures. All the systems and procedures, how the financial statements were made and how the data was being entered, etc. And checking the arithmetical accuracy of the books of account, arithmetical accuracy and verification of authenticity and validation of transactions, and ascertaining that there was a proper distinction between capital and revenue nature. You see, all these were generalization that we uh, use while preparing the financial statements, right? Comparison of balance sheet on the P&L account with the statements underlying the record, all the data, etc. And verification of title existence and value of assets, verification of liability stated, checking the results shown in the profit or loss account, and reporting to the appropriate person body whether the statement of the account examined to reveal a true and fair view. You see what they are talking. What is an audit? They have just given the process how the audit goes. First, what do? We examine the accounting systems and the internal controls. So we get to know how much, to what extent the audit procedures have to be performed and all. And then we'll also review the systems and procedures in the entity. With keeping in these mind, what do? We do perform some audit procedures. In audit procedures, what we check? We do some substantial analytical procedures, like we do some ratio comparisons. We'll check the accuracy, totaling. We'll check the totaling first, and we'll check the authenticity, whether the, with regards to accounts numerical, we'll check the accuracy. With regards to the internal controls, we check whether the data was made, the changes were made by the authorized person or not. That is what the authenticity. With regards to the monetary limits or non-monetary things. And we have to check whether, in between, we have to go some deep and check whether the P&L items and balance sheet items, whether all the capital expenditure has to be capitalized and all the revenue has to come to the P&L account. We have to check whether that had been done or not, and the profit or loss, the output of that P&L account, whether that is right or not. And with regards to the ownership, while verifying the ownership, we have to check the ownership assertion, we have to check the title deeds existence and liabilities also in the balance sheet. We have checked the P&L here, and now we are checking the balance sheet, and the result of the profit and loss also have to be checked. And we have to give a report to who appoints the shareholders, appointers. We have to give report to them addressing that. And there were two types of audit required under law, which is mandatory, which is statutory audit, like for banks, etc., companies audit. And with regards to the voluntary category, though the threshold limits were not met, but the partners there or the directors or the members there who voluntarily wanted to get the audit, because there exists some benefits with regards to the audit. What are those benefits? With regards to the financial interest of the person who are not associated, safeguards. You see, financial interests of the person is somebody who is like a shareholder that had been, or a government grant that has been given. Like there have been a lot of startups that were coming on for the encouragement of startups, right? And all this for this of the banks or the government, they were not physically or not connected with the entity in the operations of the entity, but they have some financial interest in that. The 10 lakhs or 1 CR, 10 CR, all this had some financial interest. So, in order to safeguard those financial, in order to safeguard interest of those persons, audit would be a very helpful for them to rely on us. And moral check of the employees for this is for use of management and with helpful settling liability for taxes with regards to any disputes between the GST department or excise department and all. It would be very helpful, and trade disputes between vendors, debtors and debtors and creditors, etc. And help of detection of wastages and losses, why it has been given for the environmental damages or penalties that have to be given with regards to the carbon credits and all, right, all the carbon emissions, etc. For that, we have to also, it would be very helpful for checking the wastages and the losses with regards to that. It's like mostly like an environmental audit. It's not with regards to the financial audit. You see, with regards to the audit, it involves everything, not only the financial audit, and audit ascertains whether there necessary books of accounts and allied records have been properly kept or not. Again, they have come to the books of accounts part and reviews the existence and operations of various controls in the organization when the books comes with the money and all, and with regards to that, in addition to that, followed by the internal controls. Both comes hand in hand, okay? And with help to the settlement of accounts at the time of admission or death of partners in case of a partnership firm. A government may require audit and certified financial statements. Okay, this is with regards to the mandatory statement. And these were all the benefits of an independent audit. First, what? With regards to what? Someone who has some financial interest, and for the management for the employees, and with regards to any kind of tax authorities for settling the liabilities and some trade disputes, and also settling by the case of an admission or death of a partner, and with regards to any kind of detection of wastages and losses, and all the two here were with regards to the books of accounts and internal controls, and with regards to if at all government wanted them, they have to do. And what now we'll see the inherent limitations of audit. As we know, as an auditor, independent auditor, we could just only give reasonable assurance. Why not an absolute assurance? Why can't we give 100% assurance? Is because of these inherent limitations of the audit. What are those limitations? With regards to financial reporting in which we audit, and with regards to the audit procedures, how we do audit, and a few other things. First, we'll see with regards to the nature of financial reporting under which the financial statement were prepared. That's what the subject matter in the audit, right? You see, the financial statements were prepared with many judgments. With these judgments, there could be an inherent limitation, judgments of the management. And the financial statements involve subjective decisions and assessment and a degree of uncertainty. Financial statements also involve a few kind of monetary items which have some degree of uncertainty, like with regards to the provisions, etc. And with regards to the audit procedures, two things, two key points with regards to financial reporting is some judgments, assumptions, etc. Assumptions mostly used while applying the accounting policies, etc. And with regards to some decisions and degree of uncertainty, these 2 points you have to remember for the inherent limitations. And with regards to the nature of audit procedures were, you see, with regards to the audit procedures, okay, with regards to the audit procedures, how we could do perform audit procedures with the encouragement or with the help of the management, right? You see, in order to obtain sufficient appropriate audits, how do we do? We do inquire, and we do reperformance observation and all, right? With all the cooperation of the management, we could do the audit. If the management may not provide intentionally or unintentionally the complete information, then our opinion could get affected, right? So, with regards to the management, they have not given complete information, and the audit procedures may not be effective to detect fraud. You see, with the preliminary assessment and all, we do plan the planned audit procedures and all. As an auditor, we do not have a preconceived notion that the fraud had already happened. So what do? We just do some planned audit procedures and do some risk of assessment in SE 315 and all, while just observing the obtaining and understanding with regards to the environment and all, right? And after that, if they found there's a more of risk assessment, what we have to do? We have to perform further audit procedures apart from the planned audit procedures. So, when there was no risk of material misstatement, when the auditor failed to obtain with indications of the risk of material misstatement, the audit procedures would not be that effective to detect frauds. With regards to the audit procedures and the information that was not provided by management, two aspects. And third one is, audit is not an investigation. It's not a, the auditor do not have a specific powers of like a search. So there's a limited scope for the auditor to do perform the audit. And audit procedure is determined by the auditor's professional judgment with regards to any kind of materiality, non-materiality amounts and all. That was depending upon the auditor's professional judgment. And with regards to auditor, these were the inherent limitations, audit procedures, these were the inherent limitations for an audit. And what all some other limitations were? Timeliness of financial reporting and the balance between benefit and cost, whether there have to be a kind of benefit and cost analysis for every operation or every control, right? With regards to that, financial reporting timeliness and all, there were due dates with regards to a submission of financial statements and all with that, and occurrence of any kind of non-compliance with laws and regulations by the management could also be an inherent limitation. And how do this would be? You see, when there was a non-compliance, all the original documents have been taken over by the GST department. All all the building properties or ship, they have bought some ship and all, were taken by the GST authorities or IT authorities. Now auditor has to obtain the assertion for like ownership assertion from the Xerox copies. So there's a limited inherent limitation with regards to that, and the existence and completeness of related party relationships and those transactions and all. And what's the difference between an audit and review is, what is an audit? Audit is a reasonable assurance engagement that the auditor obtains a reasonable assurance. And its objective, what's the objective of the audit is to reduce that risk to an acceptably low level in the circumstances of an engagement. That is what the definition of an audit. Review is a limited assurance engagement, and its objective is reduction in assurance to engagement risk to an level that is acceptable in the circumstances of the engagement. You see, review is having a limited assurance, limited only to that particular information, not to the whole financial statements and all, to that particular, like if they are reviewing only trade receivables, then that engagement with regards to trade receivables is a, we call it as a review. Review is of historical information which is limited assurance only, which has a only a limited assurance, not a reasonable assurance. And now we'll see few points here. Yeah. Such assurance engagement do not include audit or review of historical financial information. These were known as standards or assurance engagement. You see, standards on auditing, like that, standards on assurance engagement would also be there. You see, your standards on assurance engagement. These were standards on quality control, standards on review, and standards on auditing. These things, these two things which were in our syllabus, and standards on review were not in our syllabus. This review have a limited assurance. It's just to have an overview on how many standards were there. With regards to the assurance engagement, they do not audit the historical information. Okay, and they have some few other standards with regards to SAE 3003, 699 and all, and assurance related to the related service. There are other two things were also there. And the engagements on standards on related services, they apply to agreed upon procedures related to financial information. These were just given or like two definitions and all, because they have been given in the study material. And now we'll see a body, that is have International Accounting and Assurance Standards Board. What does its objective is? Its objective is to serve the public interest by setting high quality auditing standards and by facilitating convergence of international and national standards, thereby enhancing the quality and uniformity of practice throughout the world. Okay, what's their objective? To set high quality auditing standards. That is what? in convergence with international and national standards, that which enhances the quality and uniformity of audit in throughout the world. Okay, they're putting these all standards in the same single track. So this would strengthen the public confidence in auditing and assurance provision. And now we'll see in detail what are these objectives or how do they achieve their objectives. They achieve their objectives by establishing high quality auditing standards and guidances for what financial statement audits, other types of assurance audits, related services, and quality control covering scope of services addressed by ISAP. You see, all these lists were seen here, right? All these five only, right? What do? They give establish high quality auditing standards. It's what their objective also, right? The objective is setting high quality auditing standards. They also do the same thing. And this, there was second thing is that publishing other pronouncements on auditing and assurance matters. And with that said, we have completed the ISAP also. And now, yes, we have completed our first chapter. And you might wonder where were those SA 200s and 220s, right? You see, we have very limited period of time with regards to preparation. We have only 1.5. There was no time for repetition. You see, when we have or do repeat the same things in different kinds of papers and all, it would be very difficult to just point the same thing in our mind, while doing giving examinations, right? So all the 200s and 220s, which we have already discussed in the relevant standards, were not repeated here. Don't worry, we have not missed anything. We just not duplicated that. We have not just wasted your time in doing revision of all the things which we have already done in our day one. Okay, and now we'll move on to the next. And now we'll move on with audit strategy, audit planning, and audit program. What is audit planning is? Audit planning is like auditor establishing a overall audit strategy and developing a detailed audit plan. Both together combined is planning of audit. And now we'll see what the auditor shall do while doing the overall audit strategy. He has to identify the characteristics of the engagement and define its scope. Characteristics like nature, whether it was an assurance engagement or review engagement, overall like that, and ascertain the reporting objectives to whom he has to report to the regulatory authorities and laws with regards to that and format, or if it's an internal control, internal audit with regards to the reporting objectives with reporting authorities would be the management or TCWG or audit committee, etc., and the timing in which it has to be completed and the nature of communications required, and consider the results of the preliminary engagement activities, all the 200 series, agreeing to the terms of the audit, and evaluating the management integrity and evaluating the competence, whether they have that, and the timing and etc., all that things, when whether the knowledge gained on the engagement performed by the engagement partner for the entity was relevant or not, or else whether he has to obtain more knowledge or understand the entity more and its environment more. He has to ascertain that and ascertain the nature, timing, extent of the resources that have to be performed the engagement. This is mostly all repetitions with regards to the preliminary activities that the auditor has to do with regards to accepting the before has to do before accepting the engagement and all. You could just repeat that. And what are the benefits of doing the overall audit strategy like that? To determine the completion of auditor's risk assessment process matters, such as he has to determine what whether the resources to deploy in specific audit areas. When he do preliminary assessment, he knows where the risk of material misstatement, what all the areas he have to deploy means employ those resources the in that specific audit areas, and the amount of resources to allocate. You see where this is where, and this is how much, and where these resources are to be deployed. When this is where, how much, and this is when, all the questions like that, and how such resources are managed, directed and supervised. Such this was directed, managed and supervised by the engagement partner, such as different when team briefing and debriefing the meetings are expected to be held as the engagement team meetings, and those were all the benefits. How much, where there have to be done, and when they have to be done in regards to the meetings DSR. And now we have come to the second stage of second part of audit planning, that is developing an detailed audit plan. What does that consist of? It consists of nature, timing, extent of the planned risk assessment procedures. After the preliminary assessment, they have some thing or certain degree of risk assessment that might happen, or material misstatement that could happen. So they'll have planned some risk assessment procedures for that. And after that, they found the further audit procedures. After the plan, after doing the risk assessment procedures, they come to know the few areas have some RMM, and now they will do the further audit procedures. Like this is the additional information that they have gained during the audit, and other planned procedures other than the risk based, other like normal audit procedures they do. These all things contains in the audit plan. And knowledge of business, knowledge of client's business. What do auditor has to gain? Auditor has to gain relevant information with regards to the entity's business and its environment, right? And these were all the list of items that consist of that the auditor should gain with regards to the client's business, the relevant industry or regulatory authority or the applicable financial reporting framework. Why these? You see, with the relevant industry, they have to know that how the process was. If it's a hotel industry or hospitality, they will know how the balance sheet format has to be with regards to the applicable financial reporting framework also, and to whom they have to report. There will be separate formats of forms in which different regulatory authorities require different information, like a statutory or central statutory auditor of a bank would also have to give additional certificates like LFAR, Jilani committee, Ghost committee, like that. Other things also have to be given. So we have to know what the regulatory authorities also, regulatory requirements, and the nature of entity, whether it's operations and ownership and governance for the related party transactions, and the types of investment that the entity had, again for subsidiaries, joint ventures, associates, and all the special purpose entities, etc., for layering of investments and all, and the way the entity is structured and how it is financed, whether it's a or like thin capitalized in a or high value debt in the entity, etc., like that. And the entity's selection of accounting policies there, because these form a very significant part in the financial statements, right? And that's why we have to know that, and entity's objectives and strategy. This is why to analyze the going concern, all the entity's objectives and the management strategies, business risk, etc., all for the going concern, for evaluating the going concern and the measurement and review of entity's financial performance. Okay, this all have to be taken in consideration while obtaining the knowledge of client business. And they're talking about audit planning. Audit planning here consists of overall audit strategy plus detailed audit plan. Okay, in these both is a continuous process. You have to develop that. It's not a discrete phase. It's a continual and iterative process. Iterative is attempts, or like doing the work repetitively. If you have got additional information while during the audit, if that information could lead to change or modify certain things in the overall audit strategy or the detailed audit plan, you have to do that. So that is a continual process. It's not a process that was done not prior to the audit and all. Often begins start shortly after the completion of previous audit and continues until the completion of the current engagement period. That is, it starts before the audit and ends after the completion of the audit engagement. And the just giving the time period like that, and includes consideration of timing of certain activities and audit procedures need to be completed to the performance of further audit procedures. And the talking about the timing of the certain activities that have to be performed, like stocks and the written representation have to be not later than the audit report, and stock has to be determined as close to as the end of the financial year, right? That's why all the timings of few activities and all. And the auditor, if he need to modify with regards to additional information, he has to do that and document those changes. What all the things the auditor document? As we have already discussed, what all the auditor does, he has to document. In audit planning, what he does, He establishes overall audit strategy, so he has to do that. And a detailed audit plan, develop a detailed audit plan, he also document that. And if at all any changes, he also have to document those changes and the reasons also for that changes. And what's the auditor's responsibility with regards to preparation of overall audit strategy and detailed audit plan is he might take help of the management or the employees of the management, but he holds the ultimate responsibility. That's what they're talking about. The auditor may take help of clients, staff, etc., and recognize the fact that discussion of such audit plan would be ineffective as it would become highly predictable. So he should not discuss. Audit plan consists of what all the audit procedure that the auditor is going to perform. So he should not discuss in detail. So which would cause no surprise checks. If at all the surprise checks includes, then he could obtain more audit evidence, right? More reliable audit evidence. And auditor could also involve key engagement team members for developing the audit plan. He could involve entity staff and also the key engagement team members and allocate the audit areas based upon the capabilities and that's what. And while doing the audit program, what is an audit program? Audit program is something, a detailed instructions that what you see here. The audit areas were allocated to few team members, right? How the audit procedure have to be performed were those instructions that were given to these team members while doing constructing such audit program. What all the audit have to keep in his mind is that has to be within the scope, and it has to be a written audit program and determine the evidence reasonably available and identify the best evidence. So talking about the evidence, audit evidence, it has to be reasonable and it has to identify the best evidence from that and apply those steps, procedures which are useful in accomplishing the verification and include the audit objectives like area and sufficient details with set of instructions and consider all possibilities of error and coordinate the procedures to the applied related items. These all have to be kept in mind while preparing the audit program. And with regards to the sources of audit evidence, how he could obtain audit evidence through any documentary examination, any physical examination. Documentary examination is documenting sorry examination of any kind of documents. Physical examination like stocks and statements and explanations by management officials and employees is like external confirmation, written representations, etc. And statement by and explanation by third parties, it's a repetition. Arithmetical calculation of the auditor is again a reperformance of recalculation of the depreciation or any kind of amounts that the management had already calculated, and the state of internal controls and internal checks whether they were operating effectively or not, and the interrelationship between the various accounting data. You see, whenever there was an increase in employees, there should also be an increase in the salaries, etc., right? So we have to check the this is place where analytical procedures come, where to check the accounting data or relevance of accounting data with regards to the any kind of ratios, whether that were inconsistent with the industrial benchmarks and with that of our past period ratios, etc. And subsidiaries and memorandum records, minutes, and subsequent actions by the client. These are all the ways how the auditor could obtain audit evidence. And advantages of an audit program. What are the advantages of audit program that you have given to your engagement team member is that it provides assistance when carry it already discussed in the standards, I guess. We'll just revise it here now. It provides assistance for the audit with total and clear set of instruction. It's mostly like instruction how to do the audit procedure and all. It is essential to provide a total perspective of work, like starting point to the ending point, as he only knows whole the process, right? And selection of the assistants, it would based upon that capabilities would be more easier. It's like segregation and all. And without a written and a predetermined program, there would be a or something. It would be like a Chinese whisper. A long page could be turned out into a just or 2 to 3 lines. All the instructions could be skipped up. If it's in a written format, everything would be done right. Mostly like a checklist or a questionnaire and all. and that's why it should be of a written format. And the assistants putting their signature on the program would make them accountable for the work they have done, and the principal who can control the progress of various audits in hand of examination initiated by assistants deputed to jobs for the completed work. So the engagement partner who is there, he could control the process, how much the audit had progressed with regards to that, and to serve a guide for the audits to be for the succeeding year for the future reference purpose also. What are the disadvantages of audit program? It would be mechanical. Obviously, it would be mechanical when there were only a certain instruction. You could not go beyond that. There would be a mechanical and a restriction to the individual independence, and the program often tends to be rigid and inflexible. Obviously, that's the same thing that have been repeated again, and inefficient assistants may take shelter behind the programs. It is whenever there are preset instruction that were already given, anybody could do that. There's no or no question of having a competence or not. Whenever there were clear instructions, anybody could follow the instructions. A hard and fast audit program may kill the initiative effective enterprises. This is all with regards to the instructions and with regards to engagement team. And here they have come the disadvantage of the audit program. When the audit program is very hard and fast, that could be kill the effectiveness of that audit. And with regards to the direction, supervision, and review of the audit engagement team members, what are all the factors that would influence the nature, timing, and extent of such direction, supervision, or engagement by the engagement partner to its team members were the size and complexity of the entity. Not only this, whenever there were factors that are influencing the audit work, you could write these. It's like another keyword kit. Nature, oh, sorry, the size and complexity of the entity and the area of the audit and the assessed risk of material misstatements and the capability and competence of the individual team members. These are the factors that could affect the direction, supervision, and review of the engagement partner to its team members. And this is what we have: planning an audit means establishing overall strategy and developing an audit plan. And these are all the benefits of the audit plan. This is the definition of audit program, and it's a definition. It's something that's in relation to the overall audit strategy and detailed audit plan. They have a closely interrelated. They are closely interrelated. And first, we'll see the benefits of the planning of audit. It would help the auditor to devote appropriate attention to important areas, as they have done some preliminary assessment and all. They have planned some risk assessment procedures, right? So they could devote that area to more competent person, and helping auditor to identify the potential problems on a timely basis whenever there was a hook there, like in this area there's some a related party transaction, then we have to check all the transactions with regards to this related party. It would be on a timely basis when you communicate to the engagement team member, and help the auditor organize and manage audit efficiently and assist the selection of engagement team. This paragraph, this phrase is often repeated while doing the audit in the preliminary. It's like deploying the engagement team and selecting the competence and capabilities and all. This is often repeated. Make a note out of it. That's a key phrase for this chapter. And facilitating the direction, supervision of engagement team members and review of the work. Again, the same thing was repeated here. And assisting where applicable and coordinate the work of the auditors of components and experts. Again, with cooperation, coordination of the work of the various entities, various team members of the audit engagement team and the auditors experts or other experts. An audit program consists of a series of verification audit procedures applied to your financial statements and given a given company for the given company for the purpose of obtaining sufficient evidence to enable the auditor to express an informed opinion on such statement. This is definition of audit program. And with that said, we have completed this chapter. And now we'll see our third chapter here: audit documentation and audit evidence. Before that, I want to clarify a thing is that this chapter is a summary of all 230 to 330, 500, and all the 500 series. So I'm not just repeating and wasting your time. Okay. I just have given a few things in a page or two, all the items that were worth sharing, worth revising, and that's what we have given. And you need not read it separately for this chapter. If you have done the audit for standards on auditing, which was in day one, it would be more than enough. And and this today we are not discussing the questions and all, because it would be a very lengthy day for if we discuss the questions. Tomorrow we'll discuss it tomorrow. All the questions with regards to all the concepts that we have revised here and tomorrow also. Okay. And the use of assertions were they were kind of with regards to the P&L, class of transactions and events, all these things would come. Occurrence, completeness, accuracy, cutoff, and classification. And with regards to the account balance, that is for the balance sheet, existence, rights and obligation, completeness, valuation, and allocation, all the assets and liabilities would come. With regards to the presentation and disclosures, it comes here for the disclosures requirement, which was very well asked by the ICA in recent terms. We have to just go through for that. And the occurrence of rights and obligations, completeness. You see, completeness comes everywhere. So if at all an MCQ that comes, there was already an MCQ with regards to that completeness, which was in common for all the three transactions: completeness, classification, understandability, accuracy, and valuation. And since it is like a combination of these two, right? Because disclosures consists of disclosures with regards to items in P&L and disclosures with regards to items in balance sheet also. That's where everything had come. And with that said, we'll just move. What are the types of audit evidences? Depending upon the nature, they are say classified it as visual, oral, or documentary. We know that oral is through inquiries, and documentary is all the documentary evidence. Visual is something like you're observing the controls. That is what uh, audit evidence, even the visual audit evidence, is also taken into consideration. And depending upon the source, internal and external source, which is more, as per generalization, which is more reliable, external source was more reliable. And there's a short note here with regards to true and fair view. I will just discuss that the assets are neither undervalued nor overvalued according to the applicable accounting principles. No material asset is omitted. When you call a financial statements as having a true and fair view is when all these conditions were followed. When with regards to the assets, it should not be overvalued and undervalued, and no material asset should be omitted. And this is with regards to balance sheet. And material liabilities should not be omitted. This is again with the balance sheet part. And the charge, if any, on assets are disclosed. Any charge with regards to whether you have pledged that, etc., that has to be also be disclosed properly. This is with regards to the balance sheet. Two omissions of the assets and liabilities, and whether there was any charge and whether they were overvalued or undervalued. These are with regards to balance sheet. And coming to the P&L account, P&L account and balance sheet discloses all the matters required to be disclosed. So this is with regards to the disclosures. And accounting policies were followed consistently or not, and any unusual, exceptional, or non-recurring items have been disclosed separately. This is with regards to the disclosures, balance sheet, and disclosures. And all the matters required to be disclosed were disclosed, and accounting policies followed consistently. Unusual, exceptional, or non-recurring items have been disclosed separately. And that's it. We have completed our chapter 3 also now. And now we'll see fourth chapter, that is risk assessment and internal controls. Actually, what is an audit risk? A risk assessment is audit risk. What is actually audit risk means? A risk that the auditor gives inappropriate audit opinion when financial statements are materially misstated. This is what the auditor risk. The other way around is out of the audit scope. That was not an audit risk. Or see, audit risk does not include the risk that the auditor might express an opinion on financial statements are misstated when they are actually not. The other way around is not a audit risk. But if at all, first, for the fact the financial statements were misstated and auditor is giving an inappropriate opinion, that is giving a clean report inappropriately, is the audit risk. Audit risk consists of three types of risk: inherent risk, inherent limitations of audit, this is caused due to that, and inherent and control risk. Control risk is that the controls that were implemented by the management in the entity could not prevent, detect, or correct the misstatements that could happen. Detection risk is that the auditor could not able to find the misstatements that were already present. And we'll see the definition. These were all the definitions. Inherent risk is the susceptibility of an assertion about a class of transaction, account balance, or disclosure, either individually or aggregated, before the considerations of an related controls. Okay, and the control risk is risk that the misstatement could happen, either individual or in aggregate, will not be prevented, detected, or corrected. And detection risk is the risk is that the auditor will not detect a misstatement that had already existed. And with regards to what should not come under audit risk is that the auditor opinion is modified when the financial statements were not materially misstated. This is something that was there. And with regards to a short note on risk of material misstatement, what are the types of risk of material misstatements were? Financial statement level. And financial statement level is that it affects more than one account balance, or more than one class of transactions, or more than one type of disclosures and all, for a lot of assertions. That's what our financial statement level. And assertion level is that one particular account balance or one particular class of transactions, it is that. And I think we have already discussed with regards to that. And the risk of material misstatement at overall financial statement level to the financial statement as a whole, which would affect many assertions. And assertion level is that risk of material misstatement at assertion level, that one particular class of transactions. And that's it. With regards to the components of risk of material misstatement, there were two components: inherent risk and control risk. Audit risk consists of risk of material misstatements and detection risk. Risk of material misstatement consists of inherent risk and control risk, which was widely tested in MCQs also. And what are risk assessment procedures? We have also come across these risk assessment procedures in previous chapters, right? In 201. And with regards to the inquiries of management and of others within the entity, in auditor's judgment, may the information is likely to assist in identifying the risk of material misstatement due to fraud or error. That is, auditor doing inquiries with the people in the entity, the management or others. And analytical procedures. Analytical procedures was something, it's like comparison, the relationship between, or something between the financial statements and, sorry, financial information and non-financial information, like a rent to the square feet, or number of employees to the wages or salaries that were given, or like ratios, it's forming a ratios. And observation is observation of the controls that were being performed by the entity officials, etc. And inspection of the documents. And how do we evaluate the control risk? As we have already said, control risk is something that it is that controls do not prevent, detect, or correct the misstatements that were happening in the financial statements. And how to evaluate that risk is that through its influence over the internal control, the controls environment, that is, the control environment influence over the internal controls. A control environment that supports prevention, detection, and correction, which creates a greater confidence for the reliability of the internal controls within the entity. And it does not guarantee the effectiveness of specific controls. Control environment is something who puts the controls over there. And internal control is who does the internal controls, all the controls and all. We have also discussed the hierarchy of the internal control system on the control environment and all, right? And this who make the rules and those who follow the rules. And as of that, even the rules were good, it would not guarantee the effectiveness of the controls, because there could be a fault in the maintenance of a fault in the execution of those controls. And with therefore the test of operating controls for significant class of transactions when we plan to take controls reliance strategy. So we have to test the operating effectiveness. Even though the rules were good, rules were great, we have to test the how they were operating, whether they were operating effectively or not. We have to test the execution part. And the control environment may undermine the Effectiveness of the specific controls is a key factor in our control risk assessment. We also have to check how the control environment was there, how the rules were being formed. Evaluation of related IT process that support application and IT dependent manual controls. Evaluation of the related IT processes with regards to the how the IT system was being, how data was entered, and how it's going to travel through and give an audit or give a report out of it, and that support the application and IT dependent manual controls, how the applications were being run, and the IT dependent manual controls was something, the data that was being used for decision making, like it was used mostly by the TCWG or CFO levels, or they take the report from the IT process that was already implemented, who somebody enters the data, and somebody has prepared the IT system that was generated, and the CFO or the high level uses that data. So there has to be a reliable thing so that to have more concerned or informative decisions for the future business decisions and all for that. And our testing approach over significant class of transaction and disclosure procedures, and expectation of how operating effectiveness the controls were in the entity. When the auditor finds control deficiencies, what the auditor has to do, he has to identify or evaluate how significant those matters were, how could it affect the financial statements. He has to affect do that, and also evaluate whether he could rely on the internal controls or not, or he has to perform all the procedures in order to obtain sufficient appropriate audit evidence. There's a question that whether he has to rely on the controls or not. Otherwise, if they were operating effectively, he could rely on that. If not, he cannot rely on the controls. And if deficiency relate to one, what can go wrong out of several, what can go wrong. That is, he like it's only for a particular item. It's only for a particular small. It is mostly like an assertion level. Only for that particular item, he can rely on internal controls. But if it's for many assertions, for many things, he cannot rely on those controls. And what are the objectives of internal control were? Internal controls were transactions are executed as per management's authorization. You see, this is internal controls were something who execute the controls that were already done by the management, all the rules that were framed by the management, and all the transactions were promptly recorded, corrected in the accounting period, etc. And all the assets were safeguarded from unauthorized access, and the recorded assets compared to the existing assets at reasonable intervals, and appropriate action has been taken place for the difference amount. You see here, all the things have been with regards to only the financial statements, all the internal controls with regards to the financial statement, like safeguarding of assets that have been given here, and authorization of data, and reconciliation of the assets, and how the accounting process goes. And what are the benefits of understanding internal control? As per SA 315, we have to obtain understanding of the internal controls also, right? So what are the advantages if we understand the internal controls? First thing, we will know whether we have to rely on the internal controls or not, and will know how the operating effectiveness of the internal controls. With that, if the internal controls were operating effectively, then there could be a reduced chance of risk of material misstatement. So we could just no need to plan the further audit procedures, like for the if we have to perform for the fraud or risk factors, we have to perform the further audit procedure. We need not do that. We could just go with the planned audit procedures, and we'll just discuss that, identifying the types of potential misstatements, and identifying the factors that could affect the risk of material misstatement, and design nature, timing, extent of further audit procedures. And what are the limitations of internal control? What are the limitations of internal control? Internal controls were at the time of execution, when there was more human judgment was involved, where humans were involved, and also judgments and people, whenever there were of internal controls and automated controls. For with the automated controls, when the IT system was a flaw, there was a flaw in the procedure of how IT systems were being made, or how they have been drafted. And second thing is with the people, with regards to the people, and third thing is with regards to the rules and regulations and interpretations. First, we'll see the limitations of that. Internal control can provide only reasonable assurance like an auditor, even internal controls only could provide reasonable assurance. Why? Because there was a human judgment that could be happening in decision making. What they are talking about decision making, it is using IT dependent manual controls. You see, taking decision based on the reports that were generated by IT systems, which were maintained, which were have been created. Those IT systems were created by some other parties, and the data was entered by some other parties, and they were also be processed, or there could be an unauthorized changes, etc. They're talking about that, and lack of understanding the purpose of that, and collusion among the people. That is like two three people combined together, and see, people from IT department and from other departments, or accounting departments, collude together in sharing of the passwords, and they could change which was already authorized, and which those who were changing that was having unauthorized people. Okay, and those and judgments by the management, and limitations in case of small entities, like they cannot afford for a well customized or tailor-made accounting or systems. And with regards to the controls relevant to the audit, all the audit controls relevant to the audit, they were talking about the inherent limitations of the audit procedures, etc. Where it's mostly like auditor's judgment, etc. And information that was no, may not, willfully, intentionally, or not intentionally, may not be provided by the management, and also. And what are the factors relevant for auditor's judgment? Whether a control individually or combined is relevant for the audit. Could be asked as a direct question with regards to what all those were: materiality, significance of related risk, and you see, what are the factors? Auditor obtains information with regards to ask items, right? He has to determine with his auditor's judgment that whether this particular information was relevant for the audit or not. What are the factors that he should do, whether to judge whether that item is relevant for the audit or not, is first in materiality, and with regards to the risk, size, nature, and all the ownership characteristics and all, which have already discussed. These were some key terms which we have to dump it over whenever we find anything factors that were comes for the judgment, and all the size, nature, ownership, etc., and risk, materiality. These all something common items which we have seen a lot of times, and applicable regulatory authorities, and whether there were nature and complexity of the systems in the part of internal controls, etc. All the factors, you need not remember all this. Remember 4 to 5 points which were have been already discussed, already have been in your mind. You could write that. You see, remembering all the 10 to 12 points and forgetting that wouldn't make any sense than just remembering 5 to 6 points and gaining three-fourth or half of the marks, right? That would be a most clever way to read, a smart way to read. And what are the components of internal control? This is again a direct question. Control environment. Control environment is someone who makes the who makes the how internal controls have to be, who makes the rules and regulations, and entities risk assessment process. These people would assess how these process were, whether they could assess the risk, or prevent, detect, and correct the misstatement or not. After the they will check the rules and regulations that were provided, that were made by these entities. An information system including related business process and to the financials report and communication. They provide additional information to make any changes to the rules and regulations. Control activities was something who executes the internal controls that were made by under these rules, and who monitors the control. Monitoring is by like a manager, who these were done by the employees or staff. Monitoring of controls by the manager, manager who is monitoring how the controls were being performed. And that's it with regards to the internal controls. And what are the elements of control environment? We have seen here, right? Control environment who make rules. Okay, we'll see what all the element it consists of. It consists of communication of integrity and ethical values, and commitment to their competence, participation by TCWG, management philosophy and operating style. These all the 4 points would be like what comes into our mind whenever we think of control environment, right? Have to make some more effort to just go down and remember these 2 points. And this human resource policies is also, that's very easy to remember. organizational structure, and the assignment of authority and responsibility. This all you need not remember, but I have just given, like it would be like a very vague thing, right? You see, these all the separate paragraph I have not given here because the heading itself would make some sense for you to remember, but simply an organizational structure would not be given for you to remember like that. So I have just given to make you remember. That's it. And these were all the elements of internal controls, how the management's integrity, ethical values, and competence, CWG's management philosophy, and human resource policies, etc. See, these are all the rules and regulations that the entity has to follow. You see, I'm going fast because by this time you have been preparing for your examination and you have to give your examination within 10 to 15 days. So I don't want to waste your time in discussing each and every simple thing. I could give examples for everything and discuss from various kinds of things. But I want to just make you have a quality time with me. And so it is better to discuss, brief up something, just brush up the concept which we already know. And that's why I'm just being in a fast pace. If you are preparing for not for this attempt, like May 2023 attempt or not, or if you haven't had uh, at least two revisions for audit, I think you don't understand what I'm talking about. Entity's risk assessment process. Auditor shall obtain understanding of whether entity has a process for identifying the business risk relevant for the financial reporting objectives. It is that risk that the management cannot able to do the financial statement as per AFRF. That is what the risk they're talking about. And they're not talking about the business risk, etc., or the litigation risk. They're talking about the risk relevant to the financial reporting objectives and estimating the significance of those risks and assessing the likelihood of their occurrence. You see, first they have identifying and they were measuring. Same like application of an AS. First we have to identify and then when we have to measure, it's like estimating the significance of risk and assessing the likelihood, the probability of happening, and deciding the remedial actions for thereof. And this is actually a process to remember. We have to identify the risk and estimate the significance of the risk and probability. That's the likelihood of happening that risk, that the management could not able to prepare financial statement as per AFRF, and decide the appropriate actions that have to be taken. And how do evaluation of internal controls work? There were four methods: a narrative record, and a checklist, a questionnaire, and a flowchart. It was most widely asked in case-based scenarios or case scenarios, or they have asked mostly in that. Think I didn't remember the case scenario number, but it was there. Okay, what all you have to do is you have to remember the definition. That's it. They'll give the definition and ask whether it's a narrative record or checklist or a questionnaire or a flowchart. For flowchart, what is the key point? A graphical representation. And for the questionnaire, it is a series of questions, and a checklist is the instruction that were given. And with regards to a narrative record, it's like description of already happening controls or happening. Sorry, what had happened? Yeah, yeah. This is a completion or description of a system. Yeah, description of a system, etc. It's like narration. It's like giving narration. Okay, like commentary, giving like a commentary, narrative record of a system. And these were the disadvantages of the narrative record. And it was given in the study material, so I have just added here, and they haven't given much significance to this. To comprehend the system and difficult comprehend a system is quite difficult. Is to describe a complex system. You see, entities of a large in size, it's very difficult to obtain understanding by a particular few people, etc. It's very difficult in that, and to identify the weakness gaps in the system. And they're just describing is like just rules. We cannot know the weakness that would happen unless we do reperform those controls. So there's a point with regards to that. Incorporate the changes in the account, reshuffling of manpower, etc. And these were all the disadvantages of narrative records. And checklist, questionnaire, and a flowchart. That's it. And with regards to the entity system of internal controls, those contains of manual elements, which often contains automated elements. The characteristics of manual or automated elements are explained here. You see, here what they were saying, Some explanations with regards to what are manual controls and automated controls. Controls which are in manual are mostly like approvals, reviews of transaction. It is like approval of some certain transactions, like audit committee giving approval to few transactions that were taken by the management and all. Those were the manual controls. And an entity you may use automated procedures to initiate, record, process, and report the transaction. This is SAP, implementation of SAP. Initiate a transaction for a sale transaction that had it automatically generates the invoice, and that particular sale transaction would even be recorded or travel till disclosure or till the P&L statement, or till the balance sheet or cash flow statements also. So that is what an automated process was, the SAP, and here it's the approvals that were mostly taken by the higher level of management. And further, manual controls may be independent of IT. The manual controls is something like taking decisions, right? They may use reports that were generated by IT, or they may use another information with regards. So they were independent of IT and functioning of their IT and automated controls. So that's what they're talking. It depends upon the information that they use. If they use IT reported IT generated reports, it was dependent on IT. If they do not use those reports, they were independent of IT. Generally, manual elements in internal control are less reliable than automated elements because they can be more easily bypassed, ignored, or overwritten. Why they are saying is that manual elements were mostly done by the management, which do not have a predefined set how to behave. It would be mostly based upon the judgments that will be happening. So it is not more reliable by the auditor for that. Automated elements was something that if auditor walks through the process by doing just a normal entry, he could know how the data had been traveling and all throughout the audit, which is rigid, which cannot be based upon the judgments of some other humans involved in between. That's what they're talking about. They're mostly talking about the manual controls, automated controls. What are those? And they're talking that manual controls are independent of IT, and manual elements were less reliable due to this. Okay, and that's it. And with regards to the materiality and audit risks, which were considered throughout the audit, when identifying assessing of risk of material misstatement, determining nature, timing of audit procedures, evaluating the effect of uncorrected misstatement. You have to check materiality and audit risk while doing risk assessment procedures, and while determining the extent of audit procedures, and while evaluating the uncorrected misstatements and all. You have to use these two things. And this is was need not be in an application format. It was mostly given, it could be given as an independent question. So just add it here. In these three situations, materiality and audit risk were considered. That's it. There's nothing much more to discuss over here. And with regards to applicability of internal audit provisions, as we have already discussed in our monetary limits, as per Section 138 of Companies Act, and these companies have to be complied with the internal audit. They need to have an internal audit function, either by its own employees or the persons of a chartered accountant in employment, or a chartered accountant who is in practice also could be an internal auditor. And with that said, these were all the objectives and scope of the audit. This is could also be asked in the examination like this. You just have to write just only these few headings, and just compensate it with the, and just link it with the situation that was given in the question, like activities that related to the governance and risk management and internal controls. And for the internal controls, evaluation of the internal controls, examination of financial and operating information and operating activities, and compliance with laws and regulations. Do you have to remember these diagram? Yes, you have to remember this diagram. And there was a small note on internal financial controls. The policies or procedures adopted by company for ensuring the orderly and efficient conduct of the business, including company's policies, safeguards of assets, and prevention and detection of frauds, and accuracy and completeness of accounting records, and timely preparation of reliable financial information. You see, we also have discussed what's the difference between internal controls and internal financial controls. Internal financial controls were internal controls with regards to the financial statements environment. Internal controls only into the accounting department for say only to the accounting department. And if it's you talk about the internal controls for the purchase department and for the internal controls with regards to the production department, these were also internal controls in an entity. What are the controls? Were controls with regards to the something that entity itself within has to follow, and outsiders of or entity also have to follow, like the vendors have to follow few controls, like they have to submit the invoice within 30 days or from after the sale, etc. These were all the controls. This is what the difference between the controls, internal controls and internal financial controls. And they're talking about the policies and procedures that safeguards the assets and prevention detection of frauds in accounting records, and with regards to timely preparation of financial information, all things with regards to the preparation of financial statements. The internal financial controls are policies and procedures adopted by company. For why IFCs were adopted by company? For orderly and efficient conduct of business, including the company's adherence to the company's policies for safeguarding assets, prevention and detection of frauds, accuracy and completeness of accounting records, timely preparation of reliable financial information. Have you come across these points? Yes. In this definition, if you that's why if you learn any objectives of or something, if you learn objectives of standards on auditing, you're halfway done for that. And if you learn definitions of few things, you're halfway done for the auditing chapters, at least for the module 1, because module 1 and standards on accounting were mostly in related to each other. And this was a difference between internal financial controls and internal controls, which we have already discussed. And that's it. We have completed our fourth chapter also. And we'll discuss all the questions with regards to the matters which we have discussed in day 2. In day 3, the chapter, the video which will be coming uploaded tomorrow, we'll discuss there, because we'll have discussed a lot of topics. So this video could be long, very long. For that, I think we'll discuss that in later videos. Why do we have a special kind of chapter when for an automated environment? It is because of increasing adoption of IT and IT systems. Okay, what is the point that if business adopt IT? Because we auditors we have to form an opinion on data. So these data is generated and processed by IT systems. So that's why it is important. We have to understand and walk through the business process in an automated environment to rely the data that we are auditing on. So this is why, with increasing adoption of IT systems generate and process the data that is used in preparation of financial statements. Auditors should also often rely on data and reports that are generated from these systems. Automated environment means a business environment where process operations and accountings or even decisions are carried out using IS and IT. Process operations accounting we are mostly familiar with, but what's about the decision? The decision is about the investment decision, whether to accept an offer or reject an offer. It depends upon mostly of ROI, etc., and mostly regulatory compliances also. What are the key features of automated environment? Since it's like a dry kind of, since it's a dry topic for the key automated environment, we'll frame the topics or we'll frame the points around 3 different categories because of less manual intervention, system driven, and its of complexity. So we'll revolve around all these three and try to figure out everything with lesser human manual intervention. Because and it's faster the business operation. These two were mostly alike. Lesser manual intervention, so it's prone to lesser human error. Because it's system driven, it is faster. Because it's faster, it provides latest information. And why something is more complex? Because of its large volume transactions and connectivity in networking capability and integration of business operations. And why it is mostly system driven? What are the advantages of system driven work? Because of its accuracy in data processing and better security and controls. That's it. will revolve, we have seen around these three and have completed everything. Because of lesser human intervention, less prone to human error. Because it's system driven, it is faster, it provides latest information, and integrates between business operations and connectivity and networking capabilities. Because of its complex, its ability to do complex transactions, large volume of transaction were also there, and because of its system driven, mostly accuracy in data processing and better security and controls. For us auditors to understand, there were different kinds of automated environments. Like for the medium and large enterprise, they use ERPs like SAP and Oracle, which consists of mostly custom modules depending upon the industry they are working in or the business environment it had. So it is more complex to audit for our auditors to even understand. And off-shelf accounting software are like basic versions of software which do not contain any uh, custom modules like Tally, etc., QuickBooks. And what are all the aspects that determine the level of automation and complexity? Since we are dealing with the automation and complexity, what aspects determine the complexity or level of automation is that was how the accounting entries were documented and calculations were done automatically, and business policies and procedures and internal controls were also applied automatically. It's mostly like a questionnaire. We have to determine on what level of automation the business environment is, whether it's doing calculations automatically, yes or no. If yes, a point was set. Here we have 5 points, 5-star rating, right? Calculations, accounting entries automatically, or we have to manually enter like Tally, or it's going with an SAP where when you issue an invoice, it's get automatically accounted and reports were issued immediately. And the business policies were, whether they were applied automatically or not, whether the access security control were assigned to system roles and users. In a large organizations, we often find different kind of departments contain different kinds of usernames and or passwords to reset, and only IT department contains a privileged access to have passwords of every department. So we have to, it's mostly a bit of questionnaire like calculations, ABC, accounting entries, business policies, calculations, and reports. Obviously, after accounting entries, reports, and after for the business policies, we have to find out the system roles, security access, and security controls. What are the why IT is more relevant for doing an audit? Because what do business contains? It contains few operations. Operations here are internal controls and transactions, and compliance. We have to check for the compliance. Have you come across like such in standards, right? Or you have to in 300 series, you have to understand the business environment and transactions. 500 series compliance also 500 series, and increased use of systems and application software, complexity of transaction, high-tech nature, volume of transaction, company policy, regulatory requirement, standards or in standards, efficiency, effectiveness. With the operations, we could go for this increased systems and application software for the transaction. Transactions are increased in complexity and it's of high tech in nature and more volume and companies' policies. And what are they complying with? Are they complying with its company's policies, not prejudicial to any other acts, and regulatory prejudicial to the interest of the company, and regulatory requirements are whether they are complying or not, and Indian international standards like the and increase in efficiency and effectiveness of audit. So operations, transactions, compliance, enough. You just read it 2 times and you get that. Understanding an automated environment. Whenever you find find a question in your examination regarding understanding of any environment, put it any objective there. Any business environment or automated environment or any kind of IT environment also. You have to mention a point on SA 315 and write its objective. Objective of 315. And whenever you find a mnemonic in PDF like such, we Samaya, PDF of Samaya, have to know that it might be asked as a direct question, and you have to remember that and do not mismatch it with another question. Okay, here the mnemonic is apple of okay. here you have pulao in your plate and a spoon and a fork, and you said glass and okay, then exit. Here, interface. Interface with systems. And P stand for the purpose. U stand for why that information system is used. L stand for the location of IT systems that were there, means the servers or the data bank that was there. A for architecture of, that is mostly like an IT infrastructure. You could, it was just like that. IT infrastructure in the version that was providing, and another I is whether it was in-house or packaged. And O stands for whether it's outsourced. Whenever you could easily find out the verb because of whether that is in-house or packaged, or you have outsourced a whole process. K for key persons. And whenever we find IT, we IT and risk go hand in hand. So, what are the risks on usage of IT systems? When you open the window, it comes with light, the dust also. So, whenever you use an IT system, you could easily here are the advantages like key features, faster and connectivity, latest information, and here are all the risks that you have to face. Yeah, inaccurate processing of data. It whenever there was IT, because of its large volume of data, more risk were prone to such data and access only. So you might read it from here, or if you have already read audit in banks, mostly you could write that specific risk also, because banks also work with mostly with IT. So both risks were also the same, similar. Inaccurately processing the data, processing the inaccurate data, unauthorized access to data, unauthorized changes to systems, and failure to make necessary changes. Direct data changes, it's mostly done in backend, where if you have come across like a fraud that was rounded off all the I don't want to go into deeper, but if you have any you have a bank employee who rounds off the paisa of all accounts into and pull it into his account, that's a backend data scam, or backend data direct data changes scam. Privileged access, mostly it was for the IT systems. Lack of adequate segregation of duties and loss of data. Here, segregation of duties, you find it in banks mostly. It just comes here and there often. And loss of data. It's mostly revolves around data. You have to process the inaccurate data, inaccurately processing the data, authorization, system changes, and not making necessary changes. These were like intimate, mostly in-house. They were done mostly by specific people intentionally. What is the impact on audit due to IT risk? We'll just think of it in three different categories. Substantive audit, it's mostly not, it's like completing, auditing the complete data, not analytical procedures, etc. And controls mostly about the internal controls. We also have to give a report on material efficiency, or material weakness and deficiencies in controls, right? And reporting is like audit reports and communicating with TCWG, etc. We'll slowly go into that. And what these IT risks how do they influence in our audit? We cannot first rely on data, because there were so many risks that were with data. We cannot rely on data, so we have to do substantially or complete data. And we have to, how do we do that substantial audit? Is by acquiring more audit evidence. That's it. As simple as that. What's the impact on controls? We have to think mostly about the internal controls. You cannot rely on automated control system or IT manual dependent manual control system. Automated controls for large enterprise. IT dependent controls is like mostly the reports that you are using of. After you find the reports and etc. calculations. So these were the two restrictions. Whenever you find any restrictions, have to find the remedy for that. And what's the remedy is to do more substantive audit work, acquire more audit evidence, and completely and accurately. Data and reports should more, and reporting is, as we have already discussed, communicating with TCWG and modifying the audit report 700. Type of controls in automated environment. Here is that they were internal controls, but in an automated environment, they were comes with before an adjective like three categories, like general IT controls, application controls, and IT dependent controls. What were such? What the internal controls were segregated into these three kind of controls were. General IT controls mostly like uh, um, we'll see the we'll synchronize with the example that we already know. It's for what kind of version of tally we have to use, or from which vendor we have to purchase that tally, or um, how often we have to update the versions of the tally. And application controls is who have to enter the tally data, etc. And IT dependent control is who could access the reports. Obviously, when you do the accounting entries or general entries into the tally, you get a balance sheet and P&L account, right? And who could access such data is comes under IT dependent controls. We'll go deep into this. IT controls are pervasive controls. Whenever you find a pervasive control, it's mostly applied overall to the business environment from top management and board to the department level. They're also known as indirect controls, which whenever you find an indirect control, it's mostly like a rules and regulations that were or policies and procedures that was made by the uh, top management. Your general IT controls are policies and procedures that relate to many applications and support the effective functioning of application controls. They are not direct controls. What do is they support the application controls. They're like go for a fatherly kind of thing they support, and the main hero here is application controls. And they apply to the mainframe, miniframe, and end user environment. Mainframe is like a fast super speed computer which was mostly used for R&D, and mainframe is for the departmental staff that use, or the computers that we use, which contains a lot of storage. And end user environment is a customer side, or somebody who is using the IT systems. And general IT controls general IT controls are actually policies and procedures, right? What are the objectives of such policies and procedures is integrity of information and security of data over partners. What are partners? Again, in a mnemonic. It is program change, application system acquisition, development and maintenance, data center and network operation, and access security. Haven't got anything in your brain, right? These four things. We'll discuss deeper later after completing the types of controls. Application controls like they were automated and manual controls. Automated, why they said automated here is SAPs. When as soon as you issue invoice, the entry also gets posted. Whenever manual controls, as soon as you issue general entry, there's a manual intervention here. Operated at a business process level. They are embedded into IT applications and help in ensuring the completeness, accuracy, integrity of data in those systems. Whenever you find a data, have to know the completeness, accuracy, and because the objective here is integrity, you're saying it in integrity. Whenever you find data, try to mention completeness and accuracy. IT dependent controls, mostly manual controls, it's mostly used by the top management, which make use of data, or we such auditors information report from IT systems and applications. Its design and effectiveness depends upon the reliability of source data. Yeah. Here we have data center and network operation. We thought of to elaborate more into these four things, right? General IT controls. Here is data center and network operations, integrity of information and security of data over data center and network operations. Like how do you secure mostly the data, and how do you um, know the integrity of the data? How do you maintain integrity of the data is through backups, recoveries. Recoveries from failures, any kind of failures like power failures or any kind of threats, etc. And documentation, service level agreements, performance monitoring, etc. And program change. Program change mostly about applications. It's mostly about the applications. You have to know, you have to test change that. Have to first test, and for everything you take documentation as for granted and agreements and training. Whenever there was influence or intervention of any human into that, training also comes into picture. And whenever there's a program or software, you have to test that. To program change to ensure that modified systems continue to meet the financial reporting objectives. Why financial reporting objectives is that to design, implement, and monitor the internal controls is a duty of the management, and also to maintain the to prepare the financial statements is also a duty of the responsibility of the management. So we are combining the both here. As we are discussing about the internal control systems, we are also implementing the final objective. Final goal is to prepare a reliable or as per financial reporting objectives, the financial reporting framework that was the company is following. And access date security here also, you have application security, operation system security, data security, security policies and procedures, security organization and management. It's mostly about the programs and accessing the security. If you read it 2 times, I think you could figure it out. Application system acquisition, development and maintenance. It's mostly about the in-house in-house it deals mostly about the in-house applications or in-house programs that were maintained. It's like project initiation, mostly about R&D, etc. Analysis and design. You have to construct, that is, you have to build and then test, and then data conversion and document and training, because people were mostly involved. It's mostly a process that was implemented for the in-house development of any program. And how do you test? We have lately seen testing it here, the application that was here and the program change, it's here, right? That this is mostly about the package software kind of things. How do you test that? There were 4 ways so that you could test. That is inquiry, observation, inspection, and reperformance. Inquiry is mostly used alongside with these three, and these three are individual as per their perspective, but inquiry goes hand in hand with all these three. And reperformance is high in its effectiveness but low in its efficiency. Efficiency is easy to use. Effectiveness is the result is most accurate. The same thing we are saying here. Reperformance is most effective. I have written it efficient. Okay. And it's least efficient. Inquiry is the most efficient audit test, and it should always be used in combination with other audit testing method. Reperformance is most effective audit test, but it's very time consuming and least efficient. What are the methods of testing in automated environment? It is to obtain, okay, as we have already discussed, how do you test business process is through walkthrough is the best way, with a combination of inquiry, observation, and inspection. How do you observe? You observe how a transaction is being processed, and you have to inspect the controls, internal controls. I for inspection, I for internal controls. You have to inspect what the department staff was doing, system logins or technical manual and test check, and you have to conduct reperformance, which is most effective way to do testing of any kind of application or business process. Internal financial controls. It's actually a individual topic. As we have said, why there was financial reporting object that always coming in general IT controls is because it's the responsibility of management to maintain the internal controls and prepare financial statement. While combining that, we have said internal financial controls, which refers to policies and procedures whenever they say internal controls affecting efficiency of operations. Whenever there's financial, there exists some kind of reporting for that. Financial reporting. How do you report? You report it with help of applicable laws and regulations. Why such regulation have come? Whenever there's finance, there exists some fraud, right? Frauds, detection, prevention and detection of frauds. Prevention and detection of frauds, on what area they do is to assets. Relates to frauds, relate to assets. So you have to safeguard the assets also. So internal controls, whether they were effective and efficient, and financial reporting as per laws and regulations, and you have to detect fraud, safeguard assets. There were three stages of this is something that was not so necessary. Audit approach. There were three stages. For any audit process, there are three stages, that is planning, execution, and reporting. Whenever there was there were four steps for that. And risk assessment, it mostly deals with SA200 series, and understand and evaluate and test of operating effectiveness comes under the execution part, that is SA300 series, and reporting comes for the last stage, that and the last step, SA700 series. And okay, we'll go in deep. What does SA200 say to plan? What do you plan? How do you know whether to accept an audit or not? By actually analyzing the previous years or financial statements or previous years auditors um, work or reports, or the previous year's audit management assertions, etc. What do financial statement contains? Financial statement contains accounts and disclosures. And what does auditor comments contain? Auditor comments contain qualitative and quantitative consideration. And when they do audit, they they have already taken written representations, right? Written representations, financial statement assertions by management. And why do they give that? Because of source of misstatement, and whenever there's IT, there comes risk. That's it. You could easily write the you could easily write the all the 4 to 5 points with this. And you have to understand and evaluate. What do you have to understand and evaluate? SA300 series 315. You have to understand the business process. How do you understand that? Through walkthrough process. You have to understand walkthrough process, and you have to document that. How do you document that? Is through flowcharts or narratives, and prepare risk control matrices. And what all the controls you have to uh, understand or evaluate, etc. is, we have already seen, right? General IT controls or application controls or entity level controls on segregation of duties, etc. And how do you test the operating effectiveness of such internal controls is that nature, timing, and extent, test sample testing, testing the reports and spreadsheets. And you have to also consider um, when we said inspection, what do? We inspect the internal controls relating to the departmental staff. At that time, we have to understand the independence of that staff. Because why do we have to do is that whenever a fraud or misstatement that was made by any staff, it is easily identifiable by the audit department. But when it was done by management, it is so much curated that it was very well designed that is very difficult to identify. So we have to also uh, understand the degree of independence that was there for the staff or the team that was there. And reporting, as we have already talking about the internal controls, we have to obviously evaluate the control efficiency and provide a material weaknesses. And for that, uh, whenever we have set any restriction or risk or problem, we have to give a remedial action for that control weakness. And for that, the management have to respond. And finally, audit report. For the data analytics is nothing but to analyze a large raw form of data and provide it in a small insights and meaningful visualization charts or any kind of such stuff with use of various kind of softwares, etc. Data analytics of audit. Data analytics for audit, the combination of process tools and techniques that are used to tap vast amounts of electronic data to obtain meaningful information is called data analytics. The auditor's tools and techniques is used in applying data analytics, also known as CATs. Means the data analytic tool that were used for audit are known as CATs, and what are what the things or what the tasks that these data analytic tools were performed is to check the completeness of data. Whenever we said data, you have to write the completeness and accuracy of data, right? And data, you have to analyze the general entries as per 240 and fraud investigation. You have to uh, know the selection of audit sampling in order to avoid auditor to go for haphazard sampling, and recomputation, reperformance, and evaluate the impact of control deficiency. And how do you approach the usage of CAT, or the approach to use CATs? First, you have to understand the business environment. That's okay. It mostly revolves around 300 series. You have to understand the things and then finally report and document that. And you have to define your objectives and criteria. This is business environment and IT. What you have to understand, you have to know what are your objectives and what's your criteria. And you have to identify the source and format of data. Format of data is nothing but if you think a data was generated in a PDF format or JSON format, you have to extract that data and verify the completeness of the accurate data and apply your criteria on the data obtained, and then validate the results and then report. That's it. As simple as that, as a process. And this is how do you assess an audit finding. After all such audit, if you find an audit finding, how do you approach that? You have to know whether it's from internal control or not. If it's not something about internal control, you document it in the audit file and then conclude. But if it is from an internal control deficiency, you have to communicate with someone who is responsible for that, who are responsible to direct, implement, and control internal controls is the management. If it's management, you have to communicate with management and you have to know the degree of that, with the level of seriousness of. If it's more significant, you go to the higher authority than the management is the TCWG. If it's mediocre and you could deal it with management, you have to test the controls and you have to find the remedial actions and obtain more evidence, additional evidence, and document the results and form an audit opinion. That's it. And this is the way how do you report the audit finding that you have find it in here. How do you report this a format like what you have observed? Here they're telling is that the passwords that to reset the password, there's no formal process. They said that the exposure is a risk that was there, and recommendation, what's the remedial action that you're saying, and for what the management is responding, and that's it. And here is a glossary. Here you could go through ones which might ask in your MCQs. And don't worry, these were all mostly what we have already discussed. And that's it. After this, do not forget to do your question bank, because doing question banks help you to face your examination, and it would help you retrieve your concepts. It's not about I say do not award marks for how many times you have read or how many hours you have read. It awards you marks only when there were only to the answer that you have put on the paper, right? That is for the retrieval and your analytical skills. So you have to concentrate more on retrieval. Company audit, CA Inter. We'll see this company audit with respect to the section numbers, so it would be more helpful for us to learn topic wise. First we'll go with section 141, eligibility, qualification, and disqualification of auditors. Auditors they are referring here is the statutory auditors.
which were appointed under Companies Act. These eligibility, qualification and disqualifications with also regards with Companies Act 2013. First, we'll see the eligibility criteria. A person, why they have said a person is that that person is still not an auditor. So any person will be eligible to be appointed as an auditor only if he is a chartered accountant. A firm shall be eligible if majority of its partners were practicing in India as chartered accountants. The firm, including LLP, when appointed as auditor, only partners whose CA shall be authorized to act on and sign on behalf of the firm. As we already know, right? Auditors could be either individual or as a firm. So if it's appointing, the company is appointing as an individual as an auditor, he shall be a chartered accountant. If it's appointing as a firm, then he need the majority of partners shall be practicing in India, whether they were lawyers or chartered accountants or architectures, whoever that be, they'll be practicing in India, right? Whether it could be also doctors. Huh. And such firm, including LLP, when appointed as an auditor, only partners who are CAs shall be authorized to act and sign on behalf of the firm. With regards to the finalization audit of financial statements, what are the qualifications? Negative list. Negative list is that if at all any condition was that was given below was complied, then he'll be not eligible to be appointed as an auditor. We'll see what are all those conditions. A body corporate other than LLP. Okay. Is a partnership and body corporate? No. A body corporate is like an artificial person, or it has like company. A body corporate other than LLP, which has a separate legal existence. Yeah. So the firm cannot be a body corporate. It can be an LLP. Okay. Officer or employee of the company. The company cannot appoint its officer or employee as its auditor. Okay. The partner, employee of an officer, employee of that company. Okay, the company cannot appoint its officer or employee, plus the company cannot appoint partner or employee of its officer or employee. Okay, a person, relative or partner, who are these? Holding any security or interest in CSH, company, subsidiary, holding, associate, subsidiary of that holding. Indebted excess of 5 lakhs in such companies, and guarantee of security with respect to indebtedness in such companies excess of 1 lakh. Here, holding any shares or interest security, the auditor shall not hold even a single rupee of such share or security interest in such company, but a relative can hold up to 1 lakh of its face value. That is face value here, not the market price, the face value. If acquires more than 1 lakh, within 60 days, the corrective measure shall be taken by whom? Auditor. If that relative exceeds that 1 lakh face value limit, the corrective action shall be taken by the auditor. Within how many days? 60 days. Okay, now these were relating to indebtedness of excess of 5 lakhs in such companies, whether it would be person, relative or partner. Only the shares, with regard to shares, relative was given some threshold limit. I would say guarantee security with respect to indebtedness in such companies excess of 1 lakh. What are those companies? Company, subsidiaries, holding, associate or subsidiary of that holding. And who has direct or indirect business relationships cannot become a auditor. Except there were a few exceptions here, right? Like commercial transactions as per Chartered Accountants Act 1949, and commercial transactions in the ordinary course of business at arm's length price. So you could have an Airtel SIM and go as a statutory auditor, even as a auditor. You could have a LIC policy and you could be an LIC auditor. That's no ordinary course of business. And the next point is relative of director or KMP. Okay, the director or KMP of the company, those relatives cannot be appointed as a auditors. And the seventh point is a full-time employee elsewhere. That is, they are not telling it as an employee of the company. Employee, some full-time employee somewhere else, not a freelancer or part-time job. Somewhere else is fully employed. He cannot practice here. Exceeded 20 companies threshold limit. Okay, what all the companies that could be counted in this 20 were all companies except OPC, small and private company whose paid up share capital is less than 100 CR. Less than 100 CR, not less than or equal to. If it's 100 CR, it is counted. If it is 99 CR, you need not count. 2 digits need not count. When there's 3 digits, you have to count in the 20 companies. Okay. When he was convicted by a court for fraud and 10 years had not elapsed from the date of conviction. The last point here is directly or indirectly renders services under section 144 services. That was the auditor is providing section 144 services, whether directly or indirectly to the company. He is not eligible to be appointed as an auditor. Okay, what role such services were? It's not. It's more like services that help the company to function. Mostly like accounting, bookkeeping services, internal audit services, design and implementation of any financial information system, fintech services, actuarial services, investment advisory services, investment banking services, rendering of outsourced financial services. That is like BPOs, payroll, management services, and any other kind of services that may be prescribed in future. Okay. How do you categorize this and remember in one go? Bookkeeping services and internal audit. That's simple. We could get that. Investment advisory, investment banking services. These two could go in one way. Here is design implementation of any financial information system, rendering outsourced financial services. These two could go in one way. Actuarial management services. Okay, that's it. Any other services? Bookkeeping, internal audit, investment advisory, investment banking, design implementation of financial information system, rendering outsourced financial services, actuarial management services, any other kind services. As simple as that. And with that, we are moving on to our second topic, appointment of auditors. Appointment of auditors under section 139. Whether you're appointing first auditor or subsequent auditor, if it's a first auditor for a government company, we all know who has the authority. Auditor under PSU, C&AG. C&AG within 60 days from the date of registration of what company shall appoint the auditor. If in failure of C&AG, board of directors can appoint within 30 days after the expiry of such 60 days limit, and even the board have failed, then members in an EGM within 60 days may appoint the auditor. Okay, if it's an other, and he shall hold office till the conclusion of the first AGM. For the first auditor, his time period would be only 1 year. For the subsequent auditors, with a minimum period of 5 years. But for a government company, it's only 1 year. Okay, first auditor. Other than government company, who has the authority? Board of directors has authority to appoint the first auditor. Within how many days? Board always 30 days. From date of registration. Okay, in case of failure, members and EGM within 90 days. Why 60 days here? Why 90 days here? Here the number of members were less, because if in order to call any company or government company, more than 50% of its stake was owned by government, right? So the number of members would be less. So it's very easy to handle. So it's 60. Here you're telling it's a non-government company. There would be a wide range of members exist. So they have given an extra 30 days time in order to accumulate such services and gather. So 90 days, 30, 90. Till the hold of the first AGM. Okay, this is the first auditor provisions. 60, 30, 60, 30, 90. Subsequent auditor. For a government company, obviously C&AG within how many days? Within 180 days from the commencement of the year. What year? Financial year, not assessment year. hold the office till the conclusion of the AGM. Okay. Other than government company appointed by members of AGM. Here no board comes into picture. It's C&AG and here it's members. Hold the office from first AGM till sixth AGM. AGM what? Start of an AGM or conclusion of AGM? Conclusion of AGM. Okay. With regard to certain conditions, these conditions were disqualifications we have talked earlier, etc. And what's the notes? The notes were given to auditor here were before appointment of written consent from auditor and a certificate that his appointment is in accordance with conditions as prescribed under section 141. 141 what? What we have read it here, right? Certificate shall consist of what they are seeking for. They are seeking for a written consent and a certificate. That certificate shall consist of what? Eligibility, proposed appointment as per act, and proposed appointment is as per limits. What limits? 20 company limits. 20 company limits. And any list of proceedings against auditor or firm or partners with regard to professional matters. Why this? They have conviction by court, etc. Right? Here, where the judgment have already come, they are directly eligible. Here, there were proceedings that were pending. Okay. So that's it. These were the notes that have to be given with regards to the auditor. But with regard to the company, what were few obligations with regard to appointment of auditors were? The company shall inform auditor with respect to his appointment and also file notice of such appointment with registrar within 15 days from which auditor is appointed. You see here what are all the documents that company submits to a registrar or something other. Usually it's 30 days, but only here it is 15 days. It's a special mention. Don't go with the flow in your examination, or you try to put a bit more effort to remember it as a 15 days, or else you might get forget or go with the flow of 30 days in long run. So the company shall inform auditor with respect to his appointment and also file notice of appointment with registrar within 15 days from which auditor is appointed. Okay, that's fine. 15 days, they have to inform the auditor and submit the appointment or notice to registrar within 15 days. Retiring auditor, if retiring auditor is appointed, if he's not disqualified for reappointment, okay, no notice for unwillingness. He's not disqualified and he has no unwillingness, so he's willing to join, and no special resolution passed for not to reappoint. This is an action by company, this is an action by act, this is an action by auditor, action by company. A, action by company. B, action by such auditor. C, action by company. So as per act, you should not be disqualified. As per the auditor, he should not express his unwillingness. As per company, he should not, the company shall not pass any special resolution for not to reappoint. Then the retiring auditor shall be appointed as the existing auditor. Existing auditor will be reappointed and shall continue. What's a casual vacancy? When there was a casual vacancy, how do you look at that term as a casual vacancy? When you have done something that was unusual, but you have done it with a no specific reason or a reason which was not special to mention. What would be that reasons would be any reason under resignation or removal or any kind which is not so serious to mention about, but there was had done that. So likewise, casual vacancy here, he had got vacated the office, the auditor had vacated the office. How? Then there was a casual vacancy that had happened in the company. With regards to government company, it has to fill by C&AG within 30 days. And if in case of failure of board, 30 days. Okay. Here, 30 days. For the first auditor, C&AG 60. Board of Directors 30. For subsequent auditor, C&AG 180 days. But in case of a casual vacancy, C&AG only 30 days. 30 days. Remember that. 60 first auditor, 180 subsequent auditor, 30 days in case of casual vacancy. Board of directors everywhere 30 days. And in case of other companies, it has to be filled by the board of directors within 30 days. In case of any resignation, appointment of board of directors should be approved by the company in a general meeting. Okay. If casual vacancy had been occurred due to his resignation, auditor shall file ADT 3. Resignation ADT 3 indicating reasons. Auditor shall file ADT 3 indicating reasons if he had resigned from government company, registrar and C&AG. If it's other company, no need for C&AG, company and registrar enough. If he failed to file ADT 3, then penalty, general 50k or his remuneration, whichever is lower. If it's a continuing failure, 2 lakhs or 500 per day, whichever is lower, whichever is lower. In case of the company wanted to remove the auditor, then casual vacancy has occurred. Okay, what are all the provisions with regard to the removal of auditors? Auditor can be removed before expiry of his term by a special resolution. With what resolution? Special resolution after obtaining previous approval of central government. Special resolution, central government, in form ADT 2 plus fees. Within 30 days or special resolution, company shall hold AGM within 60 days from receipt of approval by CG. Form ADT2 shall be filed within 30 days of such special resolution. Special resolution ADT2 within 60 days from the approval of C&AG has to hold a AGM. So with regards to special resolution ADT2, with regards to approval of C&AG, what do they have to? They have to hold AGM within 60 days. 30 days, 60 days. It's as easy to remember, and an opportunity of being heard has to be given to the auditor before such removal. That's a general point. If tribunal satisfied that the auditor involved in fraud, it may direct company to change its auditor. How tribunal knows that auditor involved in any fraud? Inquiry, inspection and investigation chapter in law. Company audit, where anybody, members who thought, or any person can apply to tribunal or central government or company, apply to tribunal with regards to that, then in that case the tribunal knows that the auditor had involved in fraud and might direct the company to change its auditor. If application is made by central government, within 15 days of such application, tribunal has to make an order that the auditor shall not function and central government may appoint another auditor. Okay. Such auditor against whom final order has been passed and shall not be eligible to be appointed for 5 years from date of passing the order. After such final order was passed by the tribunal, auditor, cooling period, how much? 5 years from date of passing order, and auditor shall be liable under section 447. Okay. Appointment of auditor other than retiring auditor. A special notice for resolution at AGM. Okay. Appointment of auditor other than retiring auditor, or expressing that retiring auditor shall not be reappointed. Here this don't get confused with special notice and special resolution. Here, if no special resolution is passed for not to reappoint, here a special notice has been given for the resolution at AGM with regard to what? Appointment of auditor other than retiring auditor, and expressing that retiring auditor shall not be reappointed. Okay, on receipt of notice, company shall send notice to retiring auditor. Okay, when the auditor, after notice is given, gives his representation in writing to company and requests to notify to members of the company. Okay, auditor is giving his representation in writing, and company in any notice, that need not be a special notice. Special notice only for mentioning the resolution to appoint other than retiring auditor, or expressing retiring auditor shall not be appointed. And the company in any notice of resolution state the fact of representation and send a copy of representation. If not sent, auditor may read out at the meeting. Due to time constraints, anything could be okay. Whether he could read out or company may send a copy of such representation of the auditor. If tribunal is satisfied that such representation is being abused by the auditor, that is, he's keep on nagging about the company and complaining about the management or company, or defaming the company, then such which was not true, actually, which was not true, is just his opinion, which were not facts, then the representation need not be sent nor read out at meeting. Here the company could either send a copy of representation or auditor may read out. But if auditor is abusing his right of representation, that need not be sent nor read out at meeting. Okay. The next topic we are going to move is rotation of auditors. Rotation of auditors were not mandatory for all companies, but few classes of companies, including listed companies, but excluding OPC and small companies. What were those? Such class of companies were unlisted public companies having paid up share capital more than or equal to 10 CR. If it's 10 CR minimum, rotation is applicable. It's a private limited company having paid up share capital more than or equal to 50 CR, that is minimum 50 CR paid up share capital applicable. Unlisted public companies, minimum 10 CR. But for listed, if it's listed, that's enough. Rotation is applicable. If it's a private limited companies, minimum 50 CR or paid up share capital. And all companies having paid up share capital of below threshold limit but having public borrowings from financial institutions were more than or equal to 50 CR. That is more than or equal to minimum of 50 CR borrowings were there from any public financial institutions. Such companies were also eligible for rotation of auditors. As per section 139(2), above companies shall not appoint or reappoint an auditor, individual more than one term of 5 years, a firm more than 2 terms of 5 consecutive years. That is, the 2 terms of 5 years shall be consecutive. We are discussing about the manner in which auditors rotate as per Rule 6 of CAR 2014, where first the audit committee shall recommend to board that what do it recommend? It recommends the proposed auditor who shall replace the existing, and the company is required to constitute an audit committee if at all a company, after meeting a specific threshold limits, if it has to appoint constitute an audit committee, then board shall consider the recommendations of the audit committee. You may get various questions with regard to board has discretion and etc. and all. No, board shall consider recommendation of audit committee, and if at all the board disagrees, it has to give reasons, and audit committee shall reconsider that, or board may give its suggestions. It could be as that, but not at the discretion of board. The board recommend for appointment of next auditor by members in AGM. After board has agreed to that, it could get approval in AGM. The incoming auditor shall not be eligible if under the same network of audit firm as that of the outgoing auditor. Okay, it is mostly similar to this, right? Having common partner with that of previous audit firm to the proposed, likewise. And what are all the threshold limits to form an audit committee? Were public companies, all public companies. For the rotation, there also includes a private company and all which has more than 50 CR paid up share capital and 50 CR borrowings. Here only public company having paid up share capital minimum 10 CR, that is more than or equal to 10 CR, and having turnover or more than or equal to 100 CR, having borrowings more than 50 CR. Here more than 50 CR, more than equal to 100 CR, more than equal to 10 CR. It could be any of the, or if it satisfies paid up share capital and doesn't satisfy these two, then audit committee shall be constituted. And as per Rule 3 of CIR, the manner and procedure of selection and appointment of auditors. Here we have seen that the audit committee shall recommend to the board and board shall then send it to the AGM, etc. Right? The manner was here under Rule 3. If company has audit committee, then the committee, if not board, shall take into consideration the qualifications, experience of individual and also size of the firm proposed. Moreover, any order or pending proceeds relating to professional matters against such proposed auditor before ICI or court. Okay, what do they have to do? Audit committee shall consider what? Qualifications and experience, any kind of proceedings that were against professional matters against ICI in court. The audit committee may call for such other information which it's deemed fit. And audit committee recommend to board. Board will go and recommend it to AGM. If a company which need not require to constitute an audit committee, board shall recommend to shareholders in an AGM. And the such recommendations of audit committee, board may agree or disagree. Disagree, refer it back citing reasons. Audit committee, after considering board's reasons for such refusal, decides not to reconsider them. Then board shall record such reason for disagreement and send its own recommendation in AGM. And auditor appointed in first AGM shall continue till conclusion of sixth AGM. Conclusion of sixth AGM. Remuneration of first auditor, board of directors, remuneration of subsequent auditors fixed in AGM. Remuneration includes expenses or any other such facilities provided by him. And what are the powers of auditors, duties of auditor, and we'll see this. He has right to access what the auditor had come for. He had come to audit the financial statements, books of accounts, and to whom he has to report. He has to report it to the shareholders, members. So he has right to receive notice for the annual general meeting. It has right to attend such, and he has a right to give report. The board shall not prohibit him from giving report. And we'll see. Right to access books, right to obtain information or such any other explanation from officers like written like external confirmations or any other kind of written representation from TCWG or management, and right to receive notices and attend the general meeting. Okay, right to report to its members of company on accounts examined by him. Okay, these were all we have discussed. Right to access books, information, notice, and has right to report. He has also has right to lien on books of whom? Books of company, that is client, placed in his possession for non-payment of dues. When he could access lien, when non-payment of dues were there and books were at his possession. Okay, what are the duties of auditors? What he have come for? He have come to audit the financial statements and give an audit report. That's it, right? The same thing would be here to inquire certain matters. Okay, he has inquired certain matters with regards to what standards of accounting or act, etc. Duty to report, sign, and when he issues any qualified report, he has to cite also reason. Report on frauds, and you have to state reasons for qualified or negative report or comply with auditing standards. And what are the members can qualify, what are the reasons for which members can also qualify the audit report if accounting policies were not disclosed under Schedule 3 of Companies Act, and the accounts were not prepared under accrual basis, going concern was not followed, and proper disclosures regarding change in accounting policies were not made. This isn't an important question, but it might be asked in a direct question or a direct question. So just go through it once and just revise it before the examination. That's it. There is nothing much more. Going concern, the accounting policies disclosure and change of such accounting policies disclosure, and accounts were not prepared under accrual basis, not such an important point. Now we are dealing with joint audit. Then later on we'll go with branch audit and then cost audit, and that's it. What is joint audit? Joint audit is nothing but two or more audit firms have come together to perform an audit of a single large client. A joint audit means a pooling together resources and expertise for more than one firm to render an expert job which may be difficult to be accomplished by acting individually. Okay.
What are the advantages of joint work? So that they could share the work and share the experience, and uh, they could easily go on with that, like sharing expertise, sharing the workload, and improved service to the client, so that they could uh, have a so that they could improve their service to client and lower staff development costs. So the staff training would be, if we are a firm that was mostly concentrated on such ROC compliances or such, and another firm is in expertise in such other, we need not invest so much amount in our staff in learning that, because there was other firm that was already handling such, and healthier competition, and for better performance. And what would be the disadvantages? When you think of disadvantages in a joint audit, you go mostly with the behavioral concepts, behavioral consequences, as we see mostly in our SEMPE case studies, right? Where because of superiority complex of the auditors and problems with coordination of work, and where the common work is being neglected and fees being shared. Okay. When a joint auditor comes across a matter which is also responsibility of other auditor, requires special attention, disclosure or discussion or judgment, that is said, auditor shall communicate to those auditors in writing prior to completion of audit. That is common area work, where they were saying that a particular thing requires the attention of other joint auditor, then he shall communicate to that auditor in writing prior to completion of that audit, so that they could give their opinion on that matter. Joint auditor required to issue common audit report. Though they were two audit firms, they have to issue only one audit report, but they have difference in opinions. They could issue two different audit reports, but they have to make reference to this another audit report that was also there by the other joint auditor. And what is the audit of branch accounts? As per section 128, 1. Every company shall prepare and keep its register office books of accounts every financial year, which give true and fair view, including its branch office, that shall be kept in accrual basis and double entry system. Whether that branch would be within India or outside India, it shall prepare and keep it in register office such books of accounts, which were prepared as per accrual basis and double entry system. Books of accounts may be kept at a place where board of directors may decide and where such decision is taken, but it shall within 7 days file with register writing full address of such other place. That is, when they were placing their books of accounts other than the registered office, within 7 days they have to communicate with the registrar with such other place. If branch office is situated outside India, the account shall be audited either by company's auditor or accountant, or a person duly qualified as auditor in that other country. Okay. Branch auditor shall prepare a report on branch accounts examined by him and send it to the auditor, including fraud. Now we are going with cost audit. Cost audit is an audit process verifying what? Cost of manufacture of any article with regard to utilization of its material, labor and other costs. Maintaining cost records inform CRA 1. After a specific threshold limit, that is turnover is minimum 35 CR, that is for all products or services it was had, including foreign companies, excluding MSME. Okay. And cost audit, if it's a regulated sector or non-regulated sector. Regulated sector, when its overall turnover is more than or equal to 50 CR. If it's a non-regulated sector, more than or equal to 100 CR. If it's a plus individual turnover, that is single product or single service, where more than or equal to 25 CR, here more than equal to 35 CR. Take a minute and try to get these numbers into your head so that it could get in an MCQ. If you want to maintain cost record, if you want to maintain cost records voluntarily, you could maintain, but what is the threshold limit that was given was minimum of 35 CR of all turnover, overall turnover, minimum 35 CR. If you have crossed that, if 35 mark was set, 35 CR mark was set, you have to maintain cost records. Cost audit, when overall, if you are from a regulated sector,
Overall turnover cross the mark of 50 CR or have touched the mark of 50 CR has to maintain, or if your individual turnover from a single product touch the turnover of 25 CR, you have to get your cost audit done. And likewise, non-regulated sectors, overall turnover if had touched 100 CR, individual turnover touched 35 CR, has to do cost audit. Cost audit shall be appointed by auditor, shall be appointed by board of directors with such remuneration decided by them, and no person appointed under 139 shall be appointed for conducting audit of cost records. 139, who? The statutory auditors. Now we'll see the appointment procedures with regard to cost auditor. A cost auditor shall be appointed within 180 days or from the commencement of financial year. Have you seen such like time limit? Government auditor, CNDG appointment 180 days, subsequent auditor 180 days from commencement of financial year, subsequent auditor for a government company. The written consent and certificate shall be appointed from cost auditor, like same notes to the auditors which we have seen in appointment of statutory auditors. That certificate shall certify individual or firm is eligible for appointment under Companies Act, CW Act, and satisfy criteria under section 141. 141 what? Eligibilities, qualifications we have seen in starting of this PDF, right? And proposed appointment is within limits under the Act. That is 20 appointments, 20 companies, and the list of proceedings pending with respect to professional matters are true and correct. So this is like mostly repeated stuff where the appointment has to be done within 180 days from the commencement year and had obtained a written consent and certificate, and what they have to do, that is their appointment as per Act, and they has qualified for eligibility criteria under section 141, and proposed appointment is within limits, and they were having all the list of proceedings were mentioned in that report. Certificate was true and correct. Every company shall inform cost auditor's appointment in form CRA 2 within 30 days of board meeting in which appointment made, or 180 days from the commencement of financial year. Likewise, in statutory auditors, what do we have seen here? 15 days, right? 15 days it has to give intimation to registrar. But here, within 30 days, it has to inform CRA 2, board 30 days of board meeting, or 180 days of commencement of financial year shall file form CRA 2. Cost auditor shall continue till expiry of 180 days from closure of financial year till he submits cost audit report, which I have reached earlier. Okay. So this is his term till expiry of 180 days from the closure of financial year or till he submits his cost audit report. And what's the removal provisions? Removal before his term through a board resolution after giving a reasonable opportunity of being heard. Casual vacancy due to any resignation, death, or removal shall be filled by board of director within 30 days. The CNDG 30 days, board of directors 30 days, same time limit. And shall inform CG within 30 days, inform CRA 2. Even for the appointment with regards to normal appointment or with regards to casual vacancy, same form CRA 2. With regards to remuneration, the companies which has audit committee, what do they do? Board shall appoint cost auditor report on recommendations of audit committee. Audit committee shall recommend what audit committee do? It shall recommend cost auditor and its remuneration. What do shareholders do? They subsequently ratify. Audit committee, board of directors, and shareholders at AGM. Companies which have no audit committee, board, what do? They appoint the cost audit report and fix the remuneration. Shareholders subsequently ratify. And submission of cost audit report. The cost audit report shall be submitted in form CRA 3, CRA 2 appointment, CRA 3 or cost audit report within 180 days. Cost audit report, anything that relates to cost audit, it goes with 180 days. From closure of financial year to board of directors. To whom? Board of directors. Company within 30 days from receipt of a copy of cost audit report sent to central government, inform CRA 4 XBRL. Form CRA for XBRL. That is cost auditor to board of directors in Form CRA 3. Company within 30 days from a receipt of CRA 3 shall submit to registrar, that is central government, in Form CRA 4 XBRL. Cost audit rules are not applicable when revenue from exports in forex is more than 75% of total revenue, and operating in SEZ, or it was engaged in a generation of electricity through captive generating plant. When cost audit rules were not applicable, when its exports in forex is more than 75%, or it's operating in SEZ, or it's engaged in generation of electricity. Section 147, punishments for such non-compliance. Contravene 139 to 146, minimum 25k to 5L for the company and minimum 10k to 1L every officer in default. Or contravene for 139, 144, 145, minimum 25k to 5L or 4x the remuneration, whichever is lower. Auditor willful contravention to deceive company, 1 year imprisonment, 50k to 25L or 8x of remuneration, whichever is lower. All these penalties, remembering all such penalties could create a frustration within you. So try not to remember. I think we'll come up in future with easy way to remember penalties within 2 weeks or so. Please bear with us for such late. We'll try to figure out. Finally, our goal is to give 100% in examination, right? We'll figure out such way to find such penalties, and regarding all time limits, etc. We'll find a chart so that just 1 hour before the examination, you could refer that 2 to 3 pages of that, and you could go with the exam and do your MCQs well. And auditor convicted shall be liable to refund remuneration to company, pay damages to company, statutory bodies or creditors. Okay. If they're saying that if auditor was got convicted, they have to refund the remuneration and pay such damages. Central government may appoint any officer for prompt payment of such damages and required to file a report. When audit is conducted by an audit firm, the partners are all jointly and severally liable, but in case of a criminal liability, only the concerned partner who acted in fraudulent manner is liable. Okay, that's it for the company's audit now.
Why do normal standards on accounting or audit pronouncement could suffice for audit of banks? Why we require some separate chapter or separate regulations or separate audit procedures for auditing a bank? We'll see now. Why bank audit? Banks are backbone of any economy and essential for sustainable socio-economic growth and financial stability. All the chaos that was happening right now with crash of SVB. Banks deals with public monies and are highly sensitive to reputation risk. You see, not only for the reputation of the bank itself, but also for the government it is in, for the country it is in, for the sovereign uh, risk also makes into consideration for the banks too, because they involve, they engage with public money of the citizens of that sovereign. So for safe and sound banking sector, reliable financial information supported by quality bank audits is important. Why bank audit is important? They have public monies. So, and for the reputation risk and for reliable financial information supported by quality bank audits is important for such. What are the types of banks? First, we have commercial banks. Commercial banks provide number of products and services to general public and other segments of the economy. The two main functions were accepting deposits and granting advances. What are the main characteristics of a bank is to accept deposits and grant advances or give loans to the people. So this is normal commercial banks like ICICI, HDFC, etc. And RRBs. RRBs is mostly rural banks. These banks set up in rural areas to cater basic needs or financial needs of rural communities like Punjab Gramin Bank or Tripura Gramin Bank. And cooperative banks for a particular community. They function as commercial banks, but they were set up on basis of corporate principles and register under Cooperative Societies Act. Usually, they cater needs of agricultural and rural sectors like Gujarat State Cooperative Bank, etc. And the last one or recent type of bank that was introduced by RBI is payment banks. Like we have Amazon Payment system and Airtel's or Paytm payment system, like cash wallets. We have like a wallet cash, right? Ola wallet cash or Uber cash wallet. These were the payment banks. There are new types of banks that are introduced by RBI that allow to accept restricted deposits. Customers can open current and savings account, even facilities of ATM or debit cards, internet banking or mobile banking. It depends upon RBI is letting you all go for all these options. Mostly mobile banking was used, mobile and internet banking was used for that. They were widely used, but not allowed to issue loans or credit cards. Yeah, obviously, we cannot take loan from Amazon. Example, Airtel's Paytm Payments Bank or Paytm Payments Bank, etc. And development banks. They provide funds for infrastructure facilities important for economic growth of the country, like IDBI and SIGBI. They're mostly infrastructure facilities like project loans, etc. And small finance banks. These were set up by RBI to make available basic financial and banking facilities to unreserved and unorganized sectors, like personal loans for the farmers or MSMEs, etc., like mudra loans, etc. That's actually mudra loan is a product actually under the scheme, but a kind of such bank for small margin farmers or small and micro business units, like AU Small Finance Bank and RBI. RBI is a central bank of our country which regulates functions of banking industry. Now, how many types? Oh, type 1. Commercial banks, what do? They accept deposits and grant loans, RRBs. They were set up in where? Rural areas. Cooperative banks, they were registered under Cooperative Societies Act and cater needs of what? Agricultural and rural sectors. Payments bank. What do special keywords for the payments bank is that? They cannot give loans. They cannot issue loans or credit cards, but they can avail facilities of ATM cards, debit cards. Okay, what's the difference between a debit card and credit card? Debit card is using or spending the money that you already have. Credit card is spending, it's like a normal loan. You're spending the money which you ought to pay the next month or when the bill was made. Internet banking and mobile banking, whether the customers can open current and savings bank, yes, and they can have restricted deposits. They can accept restricted deposits, but they cannot issue loans. Example, Airtel Payments Bank and Paytm Payments Bank. Development Bank for infrastructure facilities, small finance banks and RBIs. That's it. Commercial RRBs, cooperative payments, development, small finance and RBI. That's it. What are the responsibilities of RBI? As being central bank for the country, what are its responsibilities? Development and supervision of banks and NBFCs, non-banking financial institutions. Determining in conjunction with central government the monetary and credit policies. Regulating the activities of commercial and other banks. Okay, RBI, what do we do? It develops and supervises what? Banks and non-banking financial institutions. It supervises banks and non-banking financial institutions. Okay, what do we do? Again, with in conjunction with central government, that is RBI plus central government do monetary and credit policies. That's the second thing. What do they do? Supervise the banks and non-banking, and they do monetary and credit policies. Third thing, they regulate the activities of such banks which they supervise, commercial or other banks. Okay, what are the functions of RBI? Issuance of currency, obviously. Regulation of issuance of currency. Acting as a banker for central government or state government. Acting as a bank for commercial and other banks. Issuance of license to new banks or branches. Power to inspect any bank. Okay. In order to remember these all through a mnemonic or something, it's very hard to remember. Like if we write mnemonic as a C for something, we'll get confused whether it's a currency or commercial bank, and we tend to forget that. But try to remember as a category. RBI. For what are the functions of RBI? First thing, with regards to currency and with regards to government and with regards to banks. Currency. Issuance of currency, regulation of issuance of currency. Issuance of currency, regulation of issuance of currency. Second thing, acting as a banker for central government and also acting as a banker for commercial banks. It's acting as a banker. Second category. Oh, good. And we are linking that second category to third category and issue license to new banks and power to inspect any bank with regards to banks and acting as a banker and currency. Three categories is more than enough to remember like this. It's so easy to write in an exam like that. And what are the regulatory framework is that these are all the acts that one has to remember. I think mostly these won't be asked or tested in an examination because you have to write all these acts and write the year number and all. It's very cumbersome and mostly they ask whether this is whether it was in a regulatory framework or not in an MCQ for 1 or 2 months. You could read it just one day before the examination and you're good to go. Now we'll read that. Banking Regulation Acts, State Bank of India, Companies Act. And why they are mentioning more about Companies Act and audit of banks is that banks registered under Banking Regulation Act 1949. But NBFCs, non-banking financial institutions, which register under Companies Act, is an NBFC. RBI regulates NBFC also. So that's why Companies Act was here. And because central government is having funding or being a party of a state bank, it's own State Bank, right? So State Bank Acts were there. State Bank India Subsidiary Banks Act 1959, Banking Companies Acquisition and Transfer of Undertaking Act, RRBs Act, Company Banking Companies Act 1980, IT Act. Why there was IT is here. Banks usually have a lot of transactions. You see, all the mobiles were there, payment QR codes, and internet banking, and so much of forex that's going on there, right? So mostly all the products in the banks that were used, that were introduced, were mostly of usage of IT. So they have also included the IT Act here, PMLA Act, because public money was involved, and there would be so much of fraud that might happen for conversion of black to white money, and securitization and reconstruction of Surface Act. This is normally, and Credit Information Companies Regulation Act and Payment Settlement Act. And these were for the regulatory framework. You need not remember these all. Just give it a go. That's it. RBI power to give directions. If they find any of these or within a bank, they could give directions for that particular company, etc. If they find huge volumes and complexity of transactions, and they have wide geographical spread of the bank network, and they have wide range of products that were offered, and an extensive use of technology. See, bank, when you think of bank in examination, what you need to have in mind, the first thing is about the transaction, second thing about the money, third thing is about the IT technology. And with the IT technology, what you have to think is you could use it from anywhere. So the something that's linking to IT technology is about the volume of transactions plus the geographical spread. For the from you could use your bank account from anywhere in the world, right? Yes, and strict vigilance by banking regulator. So what we need to have when there was a bank in question, that has to happen. What all our answer has to revolve around what all topics was about the transactions and about the geographical spread and the products it has in the technology. Strict vigilance of banking regulator. Moving on to what are the general banking audit reports that a statutory auditor has to give, apart from or in addition to his audit report. We have okay, relax. We'll what to why we went for a bank, why we went for an audit. We went to form an opinion on the financial statement. Prior to that, we have to find out whether the internal financial controls or internal controls in that bank were or in that entity were efficient enough or not. That's also what the responsibility of management is. Okay, you have to give reports with regards to only that. If a bank is registered under Companies Act, a report on adequacy and operating effectiveness of internal controls has to be given. Yeah, a first duty. Internal controls, as per 300, as per 300 cities and all, what we have to do, we have to, as an auditor, we have to check the internal control efficiency. If it's just saying that, we have to give an adequacy and operating effectiveness of internal control, first thing. And secondly, what we went for, we went to give an opinion on financial statement. So LFAR, it's mostly like a questionnaire of long form audit report. It's mostly like a questionnaire. So various aspects or various items of financial statement it's talking about. And banks were being regulated by RBI. RBI had set some SLR requirements, so the bank should follow. We have to check that. And our treasury operations as per RBI instructions. That's the fourth thing we have to do. And as there was so much of drama that's going on between standard assets, NPE, substandard assets, and all, we have to also check the Iraq and provisioning norms as per RBI. That's something that's related to bank. And report on serious irregularities which requires immediate attention. That's something, any deficiency or irregularity that's found by the auditor, we have to give a report on that. And as banks involve so much of money that was involved, we have to check what about any fraud that had happened. Ghosh committee is for the frauds, and Jilani committee is for the internal controls compliance status, and the report on instances of adverse credit deposit ratio in rural areas. Bank had given more loans than what the deposits it has taken in rural areas. They also have to check for that. And what we have to give. First thing about internal controls, LFAR, SLR, and treasury operations, Iraq and provisioning norms, and about any serious irregularities, Ghosh committee, Jilani committee, and adverse credit deposit ratio in rural areas. And we'll move on to the next topic, understanding the bank's accounting system. Banks' use of technology providing customers anytime, anywhere banking by letting them access their information on real-time basis as stored in a safe and secured environment is obviously that's what we are doing right now. Anywhere, anytime banking and on a real-time basis. The transactions of banks have become voluminous enough, and it is need to be ensured that in the system of recording, transmission, and storage of information is optimally maintained, and control systems ensure that same is free from errors, omissions, irregularities, and frauds. As the transactions were voluminous, what we have, what the system has to implement, what the responsibilities of the management is to record, transmit, that's communicate, and then store the information to maintain a control system so it's free from what errors, omissions, or irregularities or frauds. Okay. Considering the challenges of technology, banks management continually endeavor to make their internal control system robust, safe, and secure, as well as continuous and expeditious for the customer. Okay. I think the Spira is like for most of convenient for the customers. Like they have to make safe and secure is the keyword here, safe and secure, and they have to not miss any kind of information that is with regards to any kind of errors or omissions, irregularities or fraud, and have to put a system that records, transmits, and store all the information. And what are the banks categories? Banks were categorized into three types of level of computerization. What is this here? These were types of banks with regards to the activities the banks perform. With regards to the computerization level, we are categorizing that non-computerized banks. Transactions are done at banks in working hours with paper and pen. That is with no computers at all, and partially computerized with some transactions were computerized and major transactions were not computerized. Okay, and fully computerized. Core banking, that's CBS. CBS is something that was opted by every bank right now. This is what most of banks were doing. Fully computerized. Core banking allows interconnectivity between branches with CBS, and customer can operate from any branch over internet. Non-computerized, partially computerized, and fully computerized. And computerized, what are the difference between computerized and non-computerized? All banking activities done by computer system under computerized, and banking system was done under manually for non-computerized. Transactions anywhere, anytime, transactions only during the working hours. And this is mostly around 30 to 40 years back kind of scenario. Banking process shortens the time. Non-computerized banks takes a lot of time to process the transactions, and computerized are more productive and non-computerized are less productive. Okay, these were just go through it once, and there's nothing to remember mostly. If you remember, there's three types of banks. It's mostly the same. And our second step is control environment at bank. A bank should have an appropriate controls to mitigate the risk. That's what the management responsibility is. They have to design, implement, and maintain the internal control system and prepare the financial statement. They're talking about the control environment at a bank should mitigate the risks of any kind of risk of misstatements, risk of material misstatements. What do they could use for mitigating the risk? For segregation of duties of whom of the employees or the person on that, and providing limits for the management threshold limit for giving any kind of loans, etc., and reconciliation, VRS approvals, etc., and management engagement team discussions were all the personnel performing in engagement, including any experts like audit experts here, contracted by the firm in connection with engagement are known as engagement team. Engagement team consists of whom? Engagement partner or all the personnel who are performing plus auditor experts. They should hold meetings for a better understanding of banks and its environment, including its internal control SC 315 to assess the material misstatement. You see, in order to write anything for an audit, it was mostly like a process for the audit, like for something they're talking about the responsibilities or preliminary activities or something ethical requirements, you have to use mostly SQC1 and say 200 series or 200 series standards. And for performing audit, you have to see 300 series audit. For any specific things, you have 500 series, and 600 is for using the work of the others, and 700 forming an opinion. You have to see like that. And write phrases from those standards so that it's easier to get more marks. And it's mostly those were only the keywords there. And what are the matters to be discussed by these engagement team? What the matters have to be discussed by the engagement team of errors which are most likely to occur. Okay, errors which have been identified in prior years. They're talking mostly about the errors they have identified, and they're more likely to be occurred due to any kind of irregularities that they have found in internal controls, etc. And the method by which fraud may be perpetrated. That is how the fraud is being perpetrated, whether through its personal or whether through any kind of inventory or false or manipulation of accounts and false fictitious entries or by management. Audit responses to engagement risk and pervasive risk and specific risk. That is auditors' responses and need to maintain professional skepticism. Okay, that they are talking about the ethics here. Need to alert for information. Professional skepticism is being alert in the audit process while throughout the audit and having a question in mind. The same thing. There's a connection. Need to be alert for information that indicates a material misstatement. This mostly talking. Both were talking about the same thing. That giving a term here, but they were elaborating it more. And this to the audit response. After there's so much of errors that were identified or fraud they were talking about, auditor has to respond. So it's if you put it in a category wise, why the engagement, why any kind of discussion that has to be happen. We went to find errors, right? Not that's not the end goal, but to give an opinion. Why do we discuss? We discuss any kind of errors that were identified or likely to occur and fraud. How the fraud may be perpetrated. For all these errors and fraud, what do the auditor has to? Auditor has to respond. How the auditor respond means what makes the auditor to respond is professional skepticism in nature. And what's they were just elaborating that him to being alert that indicates material misstatement. This is how, without by hearting, you live in that situation and write answers, and you could write it full and with all the keywords, and you could gain marks, maximum possible marks in audit. And what are the advantages? Without straining your brain much. Yeah. Now we are discussing about the advantages of such engagement team discussions. It specific emphasizes on material misstatements that enables engagement team to consider responses to risk. That's like why there was engagement team discussion has to be done is putting an attention or emphasizing on material special focus on such material misstatement that was identified. It enables audit engagement partner to delegate work and determine procedures to be followed in case of fraud. Okay. Auditor has a responsibility what to report the fraud. And partner had what if he had found an fraud, what he has to do as per the regulators, or whether he have to communicate with the PCWG or regulators, and all the procedures that has to be performed, and what putting some experts there for delegating work so that it would be fully. He could report on that. Report on that. And audit engagement partner may review the need to involve experts to address the issue relating to frauds. That's what we have discussed. Special focus on material misstatements, and auditor delegates the work and determine the procedure that have to be followed. And it's also review the need of the experts, the auditor experts to address the frauds. You see, we cannot find out any kind of fraud that had happened in any electricity industry. We are not trained for that. But there was a few experts who were very efficient in electricity industry, or like telephone industry, or energy industry, gas, petroleum industries, so that we use those experts in order to report such frauds. There were so much of science that was going on there. And the financial statements of banks, in what form and content the financial statements have to be given by banks. Form A, balance sheet. Form B, P&L account of the third schedule of Banking Regulation Act 1949. Form A, balance sheet. Form B, P&L account. If you have get confused, Form A, balance sheet consists of two A's, right? Form A, balance sheet. Form B, profit and loss account. Form B and balance sheet both starts with B, and get it. This is also a trick to remember. You cannot. There is no logic behind this. This is just a fact memorization. So we have to use all these tricks to remember these in order not to write wrong in examination. And authority appointing the auditor. First, for a banking company and a nationalized bank, there were who has to make a prior approval is that RBI, because RBI regulates mostly all banks. For banking company, it's AGM, and for nationalized bank, it's a board of directors. And for the prior approval of central government, obviously we know that SBI had got a central government has got a stake in SBI. So C&AG, it's mostly like a government company. And for RBs, the concerned bank. And that's it. And who decides the remuneration for a banking company? AGM decides. Why? For a banking company consists of shareholders, right? So that's why they're talking mostly about AGM shareholders, etc. For a nationalized bank, it's not a company. It's not registered under Companies Act. And so it's a board of directors they were talking about. And nationalized bank or SBI or the others, RBI in consultation with central government. Okay. And the next topic is auditor's report. Nationalized bank or SBI, the auditor has to give report to central government. Why he has to give to central government? Because for the appointment, they have taken who appoints auditor under SEBI, C&AG, right? For nationalized bank, it was board of directors, though also it has to report to central government. Whom we report is that who appoints us, right? To whom we report. Who appoints us, we report to them. So when it's his opinion, financial statements are true and fair view, explanations are satisfactory, whether or not the transactions of bank have come to his notice are within powers, whether or not the returns received by bank are adequate for the purpose of audit, or any other matter that brought to CG notice. What he has to report? He has to report four things. His opinion on financial statements, okay. And about when we think of banks, what comes into our mind? Transactions. Whether transactions were within powers or not, okay. whether the returns received bank were adequate for the purpose of audit. Sufficient and appropriate audit evidence or any other matter, they should be brought to CG notice, like any regulatory summary. LFIR is submitted before 30th June every year. LFIR does not require an executive summary but may consider providing to bring up key observations from the whole document. Okay. With regards to LFIR, we have to remember 2 points. LFIR is have to be submitted before 30th June every year, and it need not have an executive summary but provide key observations. That's it. 30th June, no executive summary but key observations. And as we've been discussing lately, that auditor has some responsibilities to report to higher authorities with regard if you found a fraud. Now we'll see what all the responsibility of the auditor were. Fraud reporting. Fraud involving less than 1 CR. Fraud involving 1 CR or more. That is, this is 99 lakhs up to 99 lakhs and 1 lakh. If it's less than 1 lakh, report to board or audit committee within 2 days of his knowledge. That is when that fraud has come into his knowledge, within 2 days he has to report to the board. And if that company doesn't have an audit committee, if it has audit committee, he has to report to audit committee. Report what he has to report about the description, nature of fraud with description and appropriate amount involved and the parties involved. What he has to report about the nature and description of the fraud and the amount involved and parties involved. Okay. And disclosed in board's report. Discloses in board's report disclosures of the following about the nature of the fraud with description and the amount of parties involved. The amount involved and the parties involved and the remedial actions that have been taken. As the auditor had reported to the board or communicated to the board, what the board has to do. Board has to give its responses. That is what we call as management responses or remedial actions. So in board report also, the board has to mention about the fraud. And the fraud involving 1 CR or more, what the auditor has to do. The auditor has to report to central government in the following manner. Here in audit of banks, auditor has to communicate only with the central government. Here also we have seen, right, whether the auditor has to give report to central government with regards to these 4, like opinion on financial statements, transactions, information, and or other matters, right, audit evidence. Within 2 days. Whether it's less than 1 CR or 1 CR or more, it's within 2 days. Have to report to whom? Board or audit committee. This portion, 2 days, and board or audit committee is the same. And he has to seek reply within 45 days. That is, the board or the management has to give the reply within 45 days, and the auditor has to observe those audit observations, reply to the observations or remedial actions that were taken, and forward that report and the reply for the observations and comments to CG. That is, he has to report what he has given to board. Second thing, he has to also give the management responses, and he has to give his own comments on the management responses. He has to give 3 within 15 days of receipt of such observations or reply from the management. Here, this is what he has to communicate with central government. And if he had not given any reply from the board, what he has to do? He has to forward the report, a note containing that they have failed to reply to CG and his observations to CG. Whether it's less than 1 CR or more than 1 CR, he has to do what? Within 2 days, report to board or audit committee. What? The nature, description, amount, and parties. And if it's less than 1 lakh, he need not communicate or report to central government. The remedial actions were mentioned in board's report. That's fine. If it's more than 1 CR, this 45 days and 15 days comes into existence to communicate or report to the central government. That's it. Now we are moving on to the next topic, bank audit process. Firstly, what are all the initial considerations that have to be taken by the statutory auditors? As we have already discussed, when there was an initial consideration, that is prior to start of or prior to audit, what are all the things that have to be done by auditor was discussed in 200 series. With regards to preliminary activities and all, we'll see one by one. Declaration of indebtedness, that is eligibility of the auditor that you see in the company audit, similar. Situation of it's a situation where the auditor should not owe to the bank, that is, the auditor should not take loans from the bank. That's the assignments in the bank by statutory auditors. RBI decided that the internal auditors cannot be statutory auditors. You see, internal auditors mostly like employees of the company or employees of the bank, and statutory auditors were some separate independent agency or independent party. So they both cannot be the same. And planning of the audit as per SA 300 cities, you have to plan the audit as per SA 300. Auditor has to perform audit with regards to standards of auditing. and they have to communicate with previous auditor SQC1 or 200 series and professional ethics clause 8 part 1 of our schedule, and the terms of audit engagement as per SC 210 and initial engagements as per SC 510. Whenever it's an initial engagement, what all he has to check, and assessment of engagement risk, and establishment of engagement team, and understanding the banks and its environment as per SC 315. This is they're talking mostly about the generic point of view. If you write through 4 to 5 points with regards to that, it's more than enough. Mostly with regards to 200 SQC1 requirements, etc. And the second thing is identifying and assessing the risk of material misstatement. This was the duty of the auditor while planning the audit plan, while doing an overall audit strategy, and understanding the bank and its environment, including its internal control system, that is as per SC 315. Understanding bank's accounting process, that's what we have discussed above here. Bank's accounting process, yes, here. Why? Because you also have to check the internal control system, right? And understanding the risk management process. Yeah. Why we have to check or understand the risk management process is that whether the management was putting some remedial actions or to mitigate the risk of what? A risk of material misstatement, whether a risk of any fraud or irregularity that's happening. And the oversight, how do we have to understand the oversight and involvement in control process of TCWG, identification, measurement, and monitoring of risk, control activities, monitoring activities, and reliable information system. He has to check whether the TCWG is oversighting and involving the control process, whether they have established and they were supervising or reviewing the control process. We have to check that, and identification and measurement and monitoring of this. We have to identify what the risk and measure the impact on the financial statement and monitor that. And all the control activities were the internal controls, and monitoring activities is what the activities that are done by the higher level authorities like management or TCWG with regards to the internal controls. Monitoring internal controls. We have to check the internal activities, control activities, and monitoring the internal controls and reliable information system. That is the bank's accounting process. That is whether everything was accurate, all the calculations were complete on it. And the sixth one is engagement team discussions. We have already discussed that. Or you could write that and establish overall audit strategy as per SC 300. You could write from SC 300 also from them. After establishing the overall audit strategy, what we have to do? We have to develop audit plan. And an audit plan. And after audit plan, we have to do an audit planning memorandum. What is an audit plan memorandum? It is actually a summary of audit plan that describe the expected scope and extent of audit procedures to be performed by the auditor. It is mostly like a to-do list for the article extent or the personnel that were given by the auditor. Highlight all the significant issues and risks that were identified is obviously provided. Provide evidence for appropriate audit engagement plan and have respond to engagement risk, persuasive risk, and specific risk. These were the benefits of the C pointers, or mostly talking about the benefits of audit planning memorandum. That it creates an evidence for that the engagement has been appropriately performed or not, and they respond to the engagement risk, persuasive risk, and specific risk. First thing, it has to describe the scope and other processes, and second thing, it has to highlight the significant issues. Third thing, it's benefits and provide evidence for the engagement plan and the responses to such risk. And the 10th one is the determination of audit materiality. You see, I say don't go and ask to write all those points one by one. You need not remember all this. This is something that it might be tested in individual point of view. What we are doing is that we are not learning something special from this. We are just linking to already what we have learned in our audit standards. As for, if you observe this is all what we have learned. This is what we are just revising it in a certain format. That's it. You need not remember everything except this understand the risk management policies and definition of audit planning. You need not remember or memorize anything. This is, you have to make a note that you have to understand what all the things have to be written when what the topics were asked, when what topics were asked, what are the things you have to be written, and determine the audit materiality. The auditor should consider the relationship between audit materiality and audit risk. Determining audit materiality is a matter of professional judgment and depends upon the knowledge of the bank. That's it. Audit materiality is like a specific threshold limit where if after checking the preliminary activities and identifying and assessing the risk of material misstatement, auditor, by usage of his professional judgment, sets up some audit materiality like some percentage on profit or some percentage on expenses or a predefined percentage on sales, etc. He has to check the relationship between them and consider going concern and assess the risk of fraud, including money laundering, and assess the risk of specific risk and risk associated with outsourcing and response to assessed risk. After all the risks that had happened, the auditor, what he has to do, he has to respond to that risk. And they're talking about Basel III framework. Basel norms or records are international banking regulations issued by BCBS, that is the Basel Committee on Banking Supervision and Financial Stability Board, has taken an extensive review of regulatory framework. This global regulatory framework, released in December 2010, which proposed a minimum set of criteria for inclusion of instruments in regulatory capital, it focused on risk to bank and financial system called Basel Accord. This is mostly our definition. Read it once, and you need not. It's better to know the elaboration of this BCBS and etc. Know the context of what it is. So it might be tested in an MCQ. You don't need not write all these 4 or 5 lines. It was never tested like that. Write a short note on Basel III framework. Likewise, it is mostly like whether you know the concept or not. This is only for that, to know the full forms, etc. It could be asked for 1 or 2 marks in your examination, and go through it one day before the examination and review for other reports. The auditor should consider the adverse comments in what all the auditor has to read the reports. What reports he has to read? The auditor should consider the adverse comments in what? Previous year audit reports. Yes. Latest internal inspection reports of bank officials, that is head office, if you are doing it for a branch, the head office reports, etc. And Reserve Bank's latest inspection report is, or we also do supervise the bank activities. So it also gives report. First thing, last year auditor, previous year audit report. Second thing, bank's higher authority, that is bank's internal inspection reports. Third thing is the RBI's latest inspection report. Fourth one is concurrent or internal audit report, okay, and report on verification of securities. Any other internal reports, manages charge handling reports when incumbent is changed. These were all the reports that they were talking about. Now we will discuss about the advances. Advances are amount of money or credit given as loan by a bank to another party with an agreement that the money will be repaid. That's what an advance. Advance is the loan that was given by the bank that it has to be repaid. What are the types of advances? Advances are funded loans, such as loans where there is an actual transfer of funds, like bank, that is funds move from bank to borrower, like term loans, cash credits, overdrafts, demand loans, bills discounted and purchased, interest-bearing staff loans, and participation on risk-sharing basis. These were all the funded loans. And non-funded facilities, they do not involve any kind of funds transfer. Actually, bank, what do it do is it provides a guarantee. Guarantee for whom? Like for exporters or for business people, like LOC or bank guarantee, etc. These are of balance sheet items. And disclosures in the balance sheet were all the disclosures that have to be done in balance sheet were what are the bills that were purchased or discounted in the year, cash credits, overdrafts, and loans repayable on demand, that is current advances, term loans, non-current, and secured by tangible assets. These were with regards to security, and covered by bank guarantees or government guarantees, again a secured portion, and third one is unsecured one. And also C category under C is first thing, advances in India for priority sectors. Priority sectors like housing, agriculture, and public sector, that banks, and for other banks and others. Priority public and for other banks and for others. And with advances outside India, that was giving loans to outsiders, due from banks, due from others, with regards to bills purchased or discount of syndicate loans or others. Now we'll see the classification of advances. Classification of advances with regards to sector-wise. So it's priority sector or non-priority sector. Priority sectors are agricultural, MSME, education, housing, etc. Non-priority sectors were others. And for security-wise, whether they are secured or unsecured, primary or collateral for secured. Primary security is offered to borrower against which credit has been extended by bank. The security is principal security for an advance. The security is an additional security which could be of any form, whether it's a tangible, intangible, movable, or immovable. What we have seen sector-wise priority, non-priority, security-wise secure, unsecured. Under security, we have primary and collateral also. Primary is on what basis? Like if you are putting a house and taking a loan, that is our primary security. And we are all, if that after that, if we wanted to extend our loan, if we are putting gold, that's a collateral security. So this is with regards to the security wise, and what the modes of creation of security, like what are the types of creating security, like mortgage or pledge, hypothecation, assignment, set off, or lien. Mostly you have seen it in your foundation exam. For the mortgage, registered mortgage, there are two types of mortgage, that is registered mortgage and equitable mortgage. Mortgage is a registered mortgage when borrower signs mortgage deed or register the property to bank as a security, like land. You have to check while giving a loan, the bank has to change in favor of its name, change that security in favor of its name. And equitable mortgage is a mere delivery of title deeds with intention to create a security. That's mostly done by all the money lenders that we see here. Pledge. Under pledge, you have the possession is with the bank, but the ownership is with the borrower. Here, for the hypothecation, the ownership is with the bank, but the possession is with the borrower. Pledge, ownership is with borrower. That possession is with the bank. Hypothecation, possession is with the borrower, and ownership is with the bank. Assignment is mostly like a factoring, where you transfer your future asset for current money or selling that, and setting off is like netting off, and lien is mostly like a seizing of, disposing of the assets under lien. And what are the classifications of advances as RBI under prudential norms? Like assets were categorized into two: standard loans and NPAs. Standard loans is regularized where the interest and the principal amount was paid regularly. But they were, if it is not paid more than 90 days, it's treated as an NPA. But before 90 days also, SMA 0, SMA 1, SMA 2, they were categorized into these three categories. Special mentioned accounts where accounts showing stress signals, zero stress signals, and SMA 1 overdue between 31 days to 60 days, and SMA 2 is overdue between 61 days to 90 days. That is 0 to 30 days SMA 0, SMA 1 between 31st day to till 60 days, and from 61st day to 90 days SMA 2, that is special mentioned accounts. And you have a red flag over there for the NPAs. And after NPAs, you have substandards. All NPAs were substandard, and doubtful assets and loss. And we are seeing categories of NPAs. I said how much provision has to be made for the substandard assets which remained as NPA for a period less than or equal to 12 months. That is 15%. You see, after becoming an NPA, it has to be up to 12 months. Up to 12 months, it's 15%. That is overdue is this 12 months plus the 90 days. That NPA time limit also was included here. Please make a note of it. That's 15%. And for doubtful assets, there were subcategories. Doubtful up to 1 year, that is up to 1 year. Secured portion 25%, and for all the unsecured, it's 100%. And doubtful assets from 1 year to 3 years, it's 40%. And doubtful for more than 3 years, it's 100%. 25, 40, 100%. And for the loss asset, where it's totally 100%, all the provision has to be, all the loss asset has to be made a provision. What are non-performing assets? Non-performing assets are loans or advances where the interest or installment of principal remain overdue for a period more than 90 days. So if it's overdue for lesser than 90 days or up to 90 days, it is special mentioned account SMA 0, SMA 1 or SMA 2. When account remains out of order with respect to overdraft or cash credit, and the bill remain overdue for a, this is talking about overdraft or cash credit, and for the third category, they were talking about the bills discounted. They have remained overdue for a period more than 90 days. That's always a more than 90 days concept here in NPA. Out of order, if the outstanding balance remains continuously in excess of sanction limit or drawing power for the overdraft. That is, it's continuously in excess. They are not getting any sales that has to be credited to that. When the outstanding balance is less than the sanction limit, but there are no credits continuously for 90 days, as on the balance sheet date. That is, and the credits are not enough to cover the interest debited during the same period. First thing, overdrafts were designed in such a way that it is mostly to meet the working capital requirements. An overdraft, at least 85% of the sales has to be credited to the overdraft account, and all the credit should be done. So that first of all, they were withdrawing more than the sanction limit they had given. That's out of order. And second thing is there are no credits for 90 days continuously. That's out of order. And the credits are not enough to meet the interest debited. That's also not out of order. And overdue if not paid as due date fixed by bank. That's we know that. And accounts regularized near to the balance sheet date. Whenever you find such a word, when accounts were regularized or made standard, or the bank has to check whether the sources were from genuine or not. The borrower should not take a second loan in the same bank and repay that. It is like covering up the old loan with a new one. It's just like window dressing. You have to not do that. If credits are recorded before balance sheet date, they should be handled with care. If the account had inherent weakness, it should be deemed as an NPA. If it's not from a genuine source, or the borrower had taken a loan in order to repay the old loan. You see, the borrower can take loan from other bank, but not from the same bank or different branch of the same bank. And government guaranteed advances, CG guaranteed advances, where the guarantee is not invoked invoked is classified as a standard asset but treated as NPA for the income recognition purpose. This could be mostly asked in an MCQ while twisting that central government or state government, etc. all the central government advances when the guarantee is not invoked is classified as a standard asset but treated as NPA for the income recognition purpose. And advances against a consortium. Consortium is a group. When a group of banks have given a loan to a particular company under a consortium, consortium is a cluster. It's a group. Two or more banks form a consortium to advance loan to a borrower. Usually, a bank with higher share will lead the consortium. That is, as a leader. These advances should be based on records of recovery of banks, whether remittance of borrower or pooled in one bank as per consortium lending arrangement, and receiving bank is not parting with the share of other member banks. The account should be treated as not serviced in the books of other members' bank, therefore as NPA. Now, what they are saying is that they have a few banks pooled together and gave loan to a customer. Now, what the customer did, customer, as per consortium lending arrangement, he repaid that to one bank. He repaid that. Okay. Now, the receiving bank, as per this agreement, had not parted that share with other member banks. Then, what these other members have to do, that account shall be treated as NPA under the head not serviced in the books of other member banks. And that's it. And the banks participating in consortium need to arrange to get their share of recovery transferred from lead bank or get express consent from transfer of share to ensure proper asset classification. That is, all the members who are there have to try to make some arrangements and recover that. This is who has to treat it as an NPA. The receiving bank has to treat it as an NPA under this heading. And the accounts where the erosion in value of security of frauds by borrowers. Erosion means that is a decrease in the value. Here they have what they have put some hypothecation mortgage and all that, but all the security had decreased in the value or eroded in the value. Erosion means gradual destruction or diminution. They have put a building that building due to years but had collapsed, or which found that there was no value for that property. Erosion in value of security can be reckoned as significant. That's a significant matter. When realizable value of security is less than 50% of the value assessed by bank, that is, its value had eroded 50% or more. Such NPAs are classified under doubtful category, no substandard and all, directed doubtful category, and such provision is applicable. We know that, right? Doubtful categories are 1 year, 2 years, 3 years, 25, 40, 100%. And if such a realizable value is less than 10%, is loss asset and should be written off fully. That is more than 90%. That is more than 90% of value is destroyed. It is directly loss asset and should be written off fully. That is 100%. Advances against term deposits under any life policies or etc. Need not be treated as NPAs if there is an adequate margin. If there is an adequate margin, they need not be treated as NPAs even in the erosion in value. When agricultural advances affected by natural calamities, classifications is governed by a master circular issued by RBI. Banks may decide their own relief measures like conversion of short term to long term or reschedulement, etc. So, being agriculture is a priority sector, what they're trying to say is that more relief measures like if they need not categorize into doubtful category or loss asset, they could reschedule the loan or some other remedial measures. And banks giving advances to its staff. Interest-bearing staff advances are included as a part of advances portfolio of the bank. Yes, they were included in advances in case of housing loan, where interest payable after recovery of principal, the interest need not be considered as overdue because the due date for the interest is only payable after the recovery of principal. So there is no due, so there cannot be an overdue. Such advances are classified as NPA when there is a default in repayment of principal or interest. Yeah. Even the advances to staff can also would also be treated as OPA. The staff advances are given as employer, not as a banker. So they are included in other asset schedule. It's the intention of the bank. If they are giving it as an employer, other than a banker, then include it in other asset schedule. Agricultural advances with regards to long duration, if it's longer than 1 year, short duration, that is with regards to short term or long term. Long term is more than 1 year, short term is less than 1 year. With regards to crop season means the period up to the harvest. The period up to the harvest determined SLBC through any kind of regulations or directions given by it. Long term means it is treated as NPA if the installment of principal or interest remains overdue for one crop season. If long term duration, it has to be treated as NPA if it's overdue for one crop season. If it is short term, if the installment remains overdue for two crop seasons. Okay. And Well, with regards to computation of drawing power is mostly used in overdrafts and working capital loans for the hypothecation of stock. Uh, Drawing power is a limit up to which the firm can withdraw from the working capital limit that was sanctioned. Yes, sanction limit is a total exposure that bank can take on a particular client. Though the drawing power is a part of the sanction limit, but the exposure, that is the bank's risk exposure, is to the sanction limit. This total amount that the bank had sanctioned. All the drawing power and sanction limit, if they exceed or have, that is what we have seen negative, right? More than excess of that sanction limit here. Sanction limit here, where we have seen that. Oh yeah, in out of order condition. If they exceed or have granted against unapproved security, should be brought to the notice of management office. Oh, okay. And the bank should ensure that the drawings are covered by the adequacy of current assets. That's the stock statement, and DP is required to be errored based on the current stock statements. That is not older one. For every 3 months, they have to submit that stock statements which were audited. They should not be older than 3 months. They're talking about the time of 3 months. If so, deemed irregular. Those stock statements were if they were older than 3 months, then such overdraft would be treated as irregular, and the stock irregularity, there exists some irregularity, and the stock statement or the quarterly returns, audited annual report, monthly stock statements shall be scrutinized in detail. Yes. Who has to scrutinize? As we auditors has to scrutinize. While computation of DP, special attention to sundry creditors is given with extent to guidelines formulated by board of directors agreed by the concerned statutory auditors, and the stock audit should be carried out for all accounts having funded exposure more than 5 years. If the sanction limit is more than 5 years, stock audit has to be done by banks. And why they are trying to say what sundry creditors is, they also include sundry creditors here. If you see this, there was given a picture of computation of drawing power. They include stocks plus sundry creditors and their margin for that for computation of drawing power. That's why they were stressing more on the sundry creditors. And audit of advances. First, we have to obtain evidence about what amount outstanding in balance sheet with respect to advance as on date of balance sheet. Whether as on the date of balance sheet, the amount outstanding was with regards to advances is genuine or not. How do we know that? Through third party confirmations. Advances represent amount due to bank. Okay. Advances represent amount due to bank and are supported by loan document. And there are no unrecorded advances. They're talking about the completeness in the information. And that basis of valuation of advance are appropriate and properly applied, and its recoverability recognition. That is the security that they put for taking advance, the borrower. You have to take such valuations, such securities, and advances are disclosed, classified, and described as per accounting policies and practices or statutory and regulatory requirements as per rules and regulations. Appropriate provisions towards advances. Okay, these are all the evidences that we have to take with regards to advances. What we have to take? First, we have to take balance confirmations. Balance confirmations, and that they were due with the bank, and that they were due with the bank plus supported by the loan document. And were there any unrecorded advances? We have to also check that. And for that, and also what we have to check in addition is the securities, whether they have been as per policies, accounting policies, and the valuation principles were good, and all the provisions towards the advances were done as per provisioning norms as per RBI. And obtain evidence by examining validity of recorded amounts, loan documentation and their existence, enforceability and valuation, and reviewing the operations of account, carry out analytical procedures, checking the compliance of RBI. You need not remember these things. How do you have to write it in examination is go to the standards, and how do you check any kind of evidence? How do you do that? Author has to read some minutes if at all they have to take any decisions or something other than. You just live in that situation and you could write that. How do you do? First, you have to examine the account balances and securities and the operations of account, whether you have to walk through the process of that, that's operations of accounts, and carry out analytical procedures. Analytical procedures for something where you match with financial monetary elements with non-monetary elements, like something kind of stock with regards to its value. If they're showing 100 units and they're putting it as 20 lakhs, and then after 3 months they're showing as 110 and putting it as 35 lakhs, that's not something that there exists some irregularity, right? So we have to check the analytical procedure, checking the compliance of RBI norms, obviously. Internal controls over advances should include what all the internal controls you have to check for. Before making any advances, documents were executed, proper documents were executed, and satisfied credit worthiness of the borrower and sanction from authorities and compliance of terms of sanction. What all documents application has to be made.
And if they put some security, it has to be made in favor of the bank, or the title deed should be legit. All the documents have to be there, and you have to check for the credit worthiness. And there exist some limits to give advances even for the branch manager, right? You have to check whether those all sanctions were within the limits, and sufficient margin for kind of if you're doing for factoring or like bills, sufficient margin should be kept against securities, and you have to check at regular intervals. And if securities are shares, debentures, the ownership should be transferred in the name of the bank. Ownership should be transferred in the name of the bank, and securities requiring registration should be registered in the name of the bank buildings. In case of goods in possession of bank, they are test checked at the time of receipt. Okay, we should check that they were not abandoned or etc. And the drawing power register should be updated every month, and the account should be kept with both within both the drawing power and sanction limit, and the advances should be reviewed at least once in a year. So these are the internal controls that have to be in place for advances in a bank. This is prior to giving advance. This is like maintaining or reviewing every month or at a regular intervals. What we have to check? We have to check if it's an OD. We have to check whether it's within the limits of drawing power or sanction, and the DP register is updated, and the goods that were in the possession of banks were, you have to test check that about the quantity and all. And if at all it's shares and debentures were there transferred in the favor of bank, and the registration also in the name of the bank, and securities have sufficient margin or not, and these advances should be reviewed at least a year. You categorize this, so it is so easy for you to write in an examination. And how do you audit the revenue items? We have done with the balance sheet portion till now, and now we are moving on to the P&L portion. Well, first we'll see the income side, that's the revenue side. Incomes, what all the incomes that the bank would have. The responsibility of the auditor. What responsibility of auditor is to obtain reasonable assurance on what about income of that relevant period, and there was no unrecorded income. That is, it's complete. RBI advised that if any income that is more than 1% of its total income, that is on gross basis, or 1% of net profit before taxes, or it should be considered as an accrual basis as per AS 9. Mostly all banks also perform the same. All banks do prefer and have accrual basis only. This is not something to concentrate more about it. And if any item is not, if at all, why I have given is this because if at all they ask in an MCQ, you see how much well we practice in MCQs. There was still exists that new MCQ in our examination, right? We need not take chance for that. We have to do 100% effort. Main item is not material. It may be recognized on a receipt basis. You need not qualify report for not maintaining a receipt accrual basis. They need not do modify your report. Banks recognize income on accrual basis, like fees or commission, including renegotiations or rescheduling. Yeah, when there is a significant uncertainty on ultimate collection of income, that is, there is a significant uncertainty on collection of income. Then what they have to do? They have to recognize when it is realized, mostly like an NPE or loss. Interest on advances may be taken into account as on due date. Okay, interest on advances has to be taken into account as on due date when sufficient margin is available. That is, they're talking more again about the accrual basis. And bills for collection or customer account credited and communication of branch is due only when the bill is actually collected. We're talking about bills here, and it's just not. You need not remember everything like this. It is just a few snippets so that you could recollect it in one day before the examination. You see, first thing is like you need to have a reasonable assurance. That's what. And so for what we have, what's the duty of the auditor? And they're talking about the full completeness of the information. For if we audit anything, we have to check for its completeness. If we audit any kind of asset, we have to check for its valuation criteria and its existence. And this is something for the purely for MCQ purpose. And if it is, they're telling more about accrual and receipt basis. Mostly, we tend to write the correct answer, even if we read this few points of 4 to 5 points or not. We know that we have to apportion the commission that we receive for the bill purchase if it falls in between that period is there, right? Between 2 years, we have to apportion that. That's something common. We have common sense. With common sense, we can write the answers. Still of income. If any advances, including government guarantees also, we have seen it here, right? Like the government guaranteed loans, government guaranteed advances, CG guaranteed advances when the guarantee was not invoked or classified as a standard asset but treated as an NPA for income recognition. So, including those also, including those, advances, the entire amount or the entire interest amount that was accrued in past period should be reversed. And we know that it has to be recognized only on realization, that is on receipt basis. With respect to NPAs, fees commission shall also be reversed. That is, expenses in relation to that NPAs also have to be reversed, because on receipt basis, if any income that is wrongly recognized in past and is either has to be reversed, provision has to be made. Any kind of income that was wrongly recognized, what you have to reverse that income. Inquire large debits of interest income that is not explained, that is unexplained interest income, and appropriate action has to be taken with this regard. Not explained incomes has to be reversed. The component of finance income with respect to leased assets, which are accrued and credited before such asset has been NPA, shall be reversed. Such finance income, that is the interest portion for the leased amount before it is treated as an NPA, that has to be reversed. And take out finance means, take out finance is something taking a loan later and is used to replace the initial loan. That's what we have thought of practicing for standardizing the NPA account, right? Taking loan in the same bank and then not repaying the previous loan. That takeout finance means taking loan later and is used to replace the initial loan. They are mostly used in property development. That is for regularization of NPAs. This is for property development. If this is like shifting loans from one bank to the another, if it is NPA, then income shall not be recognized unless realized. We know that whether it's takeout finance or something other, if it's an NPA, we should not recognize the income. We have to recognize only on realization. Objectives of takeout finance: to expand sources of finance, that is participation of new entries in infrastructure projects, and to boost the availability of long debts for projects. Why long debt for projects? It is for like a sustainable income. Like longer the duration of the loan, more the income, more the interest income that could be get for the banks. If an account turned into NPA, banks may continue to record accrued interest in memorandum account in books of account for control purposes. If an account turned into an NPA, banks may continue to record accrued interest in memorandum account. What we have talked about here, we have to not recognize NPA interest or NPA's fees or commissions, but we could recognize that or take into account or into a memorandum account for what control purposes, for internal control purpose or bank accounting process purpose. But this interest should not be taken into account or should not be put in financial statements. It's just a memorandum account, just a dummy account. Interest on investments includes income from government securities, bonds, debentures, corporates, all the assets that you find in the balance sheet, and which excludes dividends from subsidiary joint venture, whether in or abroad India. Dividends are apportionment of profits because of subsidiary and joint venture, not investments in some other banks, which was not unrelated. So they're talking about interest income and other income here and expenses. This is just a snapshot in your study material. And what all the things, profits on sale of investment should be in P&L account and evaluation of investments in P&L account. And now we are moving on to the audit of expenses. Assess the overall reasonableness of analyzing ratios of interest paid on different deposits and borrowing. That is, they're talking about the percentage of interest that was paid on the loans that were taken by the bank. Interest paid, how do we know that? The formula is interest paid, that is interest expense divided by average deposits equal to average interest rate. That is an average, or total interest paid divided by the average deposits or borrowings equal to, you'll get what? Average interest rate. And as the weighted average interest rate and actual average interest rate, and then compare this, is they're talking mostly about some substantial procedures. And the auditor understood process of computation of average balance and recompute the sample basis. And auditor should test check basis that interest provided on all deposits up to balance sheet date, that is completeness. And interest rates are as per RBI and banks international regulations, and balance, that is HO balance and RBI balance. And auditor should ascertain changes in interest rate during the period and analyze the completeness on entire borrowing portfolio. That is, he has to, what the auditor is doing is, auditor of expenses is mostly concentrated on interest. They're talking about the completeness of the interest that has to be made for the deposit up to the balance sheet, and they're talking about the interest rates and average interest rate with regards to the weighted interest rate comparison. And they're talking about the inter-branch balances, HO and RBI balances, whether they balance with us or balance with them. And interest rates as per whether such interest rates were as per RBI and international guidelines, and auditor should ascertain the changes of interest rates also and recompute such interest rates. That is simple with regards to the audit of expenses, mostly with regards to interest they're talking about. And audit of operating expenses. The auditor should evaluate internal controls with respect to expenses, including authorization procedures. There is a limit of authorization of such expenditure. Examine if there are any divergent trends and should perform substantive analytical procedures, or auditor should verify expenses with supporting documents. These are mostly like a procedural thing. What we have to do, how we have to write this up. First, we have to check about the internal controls. Then we have to check the trends, and the substantive analytical procedures have to be performed. And then obtain evidence, audit evidence with regards to the operating expenses support with supporting documents, and audit of provisions and contingencies. And provisions is like mostly like debtors provisions or contingencies in any kind of legal expenditures, etc. And auditor should ensure that the compliance of various regulatory requirements for provision, and it includes basis for classification, and obtain the detailed breakup of all loans and agree with general ledger, obtain tax provision computation from management, and examine the adequacy of circumstances warranting provisions. Now, what they're talking about is that the auditor should ensure compliance of various regulatory requirements, that is, with regards to provisions. We know that for substandard it is 15%, loss is at 100%, likewise. For secured for different percentage, 25, 40, 100, and for unsecured 100. We have to also check for the classification and that breakup of loans. And circumstances warranting such provisions. It's mostly talking about the provisions requirement only. That is, they have to follow the rules and the basis for their classification and circumstances warranting those provisions, and the detailed breakup of all loans. That is completion of all loans into that classification category. And they're talking about contingencies or to obtain tax provision computation from the management. And that's it. We are done with audit of banks, and all the best. Please do question back, do practice, and practice